meeting is being recorded.
Cool. How's it going, guys? This is Forensic Forex with Deontay, and this is Forex Fridays. I hope you and your loved ones are safe wherever you are in the world. I hope you are doing well. I hope you had a successful trading week, or if you didn't trade this week, kudos to you. No trades taken is no risk to your equity. So, as always, we're going to be talking about the weekly range review, and in that as well, we're going to be talking about the New York and London model, the very simplistic ways to trade it. And then last topic we're going to talk about is smash day candles on the lower time frame for entries. So let's jump right into it. So looking at dollar, we're going to look at three pairs today. We're going to look at DXY, AU, and UCAD. So we just shuffled a few around. We got two correlated pairs, meaning DXY and UCAD, and then we got AU, something inverse. So we have a touch on both sides. So right away, looking at this, we always go to the weekly opening price. So the weekly opening price is generally how we're going to tell if we're going to be in an overbought or oversold condition. Now, most times, this is not obvious to most folks, right? The weekly opening price is an indication, a natural price indication to telling you whether or not your premium, meaning overbought, or discount, oversold. Granted, with those conditions, understanding that you can see based on just how the chart is laid out in hindsight, where the best sells were occurring and where the best buys were occurring. Am I showing a chart? I am showing a chart. You are not screen sharing. I thought I was. All right, cool. We'll just have to edit that out then. It's all good. You guys can see it now, right? I'm always doing this. I'm such a goof, man. Cool. Copy bubbles. All right, right. So the weekly opening price. So we're gonna be looking at DXY. We're gonna be looking at AU. We're gonna be looking at UCAD, and we're gonna talk about some of the London and New York models, and maybe even some of the Asian session models, and then we're gonna talk about smash day candles. So the weekly opening price here, natural indication to overbought and oversold levels. And many people do not utilize this, which is why they have troubles probably understanding whether or not they should be a buyer or a seller. When you put this on your chart without any context, right? When the chart goes no annotations, right? It doesn't look like much really. Now, of course, we could probably take educated guess on certain things, right? However, when we look at it with this on the chart, it starts to get a little clearer. We're like, oh, we're getting closer to the truth here. And we can see where price is sensitively reacting around what level. It's that weekly opening price. So as soon as price gets above it, for some reason, we can see it sells off. And when price gets below it, you can see buying opportunities come into play. You can see how price drops all the way down here on Thursday, and there's a huge rally up. You can even see here on Tuesday, bottoms out here on Tuesday, 9 a.m., rallies up into 4 a.m. London. So there's buying opportunities occurring in a discount, and there's selling opportunities occurring in a premium. Keep that in mind as we're watching this entire video. So we're going to go through each day. More specifically, we're going to go through Monday for the DXY. I'm going to talk about the London model. So let's go back to Monday. I'm going to go right to 5 a.m. here. And I'm going to drop down to the 15-minute time frame. So this is the preferred time frame when I'm looking for intraday setups and I'm trying to frame liquidity pools. I'm going to frame it from a 15-minute time frame perspective every single time. I'm going to be taking midnight after true day open, 12 a.m. noon in New York Eastern Standard Time, and I'm going to go all the way to 2 a.m. That is going to be a dead zone. This dead zone, I call it at least, the Asian lunch. The reason I'm calling it the Asian lunch is because it happens right after. Somebody can't hear. Can you guys hear me? Somebody in the chat said they can't hear. Let me know if it's just them. Casey said they can't hear me. Yeah. All right, cool. Yeah, man's PC bugging. All right, fam. So 2 a.m. to 5 a.m. is the London kill zone. And that's where we're looking to find the trade setup. We're just utilizing this small, it's a small window, guys, right? We got midnight, 1 a.m. and 2 a.m. We got a small window of price action here. This small window of price action can help you define a trade setup going into London session many times than not. Now, I'm not saying every single time you look at the pair that you're tracking that this model is going to present itself, but odds are, out of all the majors, at least one or two of them are going to present this model. You may not have been able to catch it because you weren't watching it. What I'm going to do is take the 15-minute swing highs, buy side liquidity, obvious areas of liquidity. If there's any swing high that's higher than this, or a high in general, I'm going to use it. So midnight, that high there, I'm going to take it. I'm going to take that one here. The lowest low we have here is going to be the one at 215, or within the ending or span of this 215-minute candle. So we'll take that. So we have our liquidity pools framed out. Easy way to just view it. Money, money, money. You got sell stops and buy stops. We're going to mark off 2 a.m.'s opening price, because the same ideology I was just showing you on the weekly time frame is the same thing that could be seen in the kill zone itself. Now, this was really groundbreaking for me, because when I realized that all the markets are just fractal, and I was like, oh, you can apply the same idea to the kill zone, because it makes sense. You want to buy below the open if you're looking for a buy setup. You want to sell above the open for the sell setup. And you'll see how the market makers or the algorithm is going to methodically price in PD arrays and take out counterparty liquidity to then gear itself in the opposite direction. Let's play this forward one candle. You can see price comes out and takes out that low point that we had marked off as sell side there. Right there, there's a purge on sell side liquidity. We're also below 2 a.m.'s opening price. Now I'm going to ask the chat, is below the opening price premium or discount? Anybody can say it, and I'll type it out. Below the open, is that discount or premium? Discount. Correct. Good job, guys. Excellent. So that would mean, of course, the only answer for the upside is going to be premium. Anything above is going to be a premium. Great job, guys, in the chat for saying that. So we know, as a retail trader, just going in, thinking about it, right? The fact that I see price below 2 a.m., I'm not looking to be a seller. I'm more than likely looking to be a buyer, especially after framing counterparty liquidity pool being taken out, sell side, and I'm in a discount. So which hat am I going to play? Am I going to play the buyer or am I going to play the seller? I'm going to play the buyer. I'm not going to put on the seller's hat. There are going to be situations where you will have to put on the seller's hat, but more times than not, the buyer opportunity is what you're looking for, because you're in a discount and because you took out and mitigated sell side liquidity. I would drop down to the 1 minute now, because I want to see what's going on here at this point. That's the beginning here. I know some people start their London session at 1 a.m., right? There's a lot of confusion behind that as well. Some people started at 1 a.m., some people started at 2 a.m. I started at 2 a.m. The reason I started at 2 a.m. because that's European Open, right? I want to start at European Open because it's a staple. Some people want that extra hour window, daylight savings. They want that whole entire hour. To take the extra hour if you want to. I don't think much would change, because you're including a whole hour more of data. But I prefer, and I've been sticking with 2 a.m. ever since I've learned 2 a.m. kill zone open, European Open, 2 a.m. What I'm looking for now is a simple PD array. Now, there can be two entries. There could be a smash candle entry, which is probably the one that most people are not going to see. This is the one that's going to print really early and is going to catch a lot of traders off guard. But we're going to talk about that in our last topic. The other entry technique that I generally look for is just a fair value gap that breaks a swing high. And we're going to look to see if that happens. If not, I'm going to look for any PD array that is going to be making market shift higher, right? There's a market break and there's a market shift. I want to see that market shift. So let's play it forward. So far, no fear. Let me zoom in closer because I'm blind. Right, that's that low, right? Between that 215 candle, 215, where's it at? 215, right? That's that whole candle here from 2 a.m. to 2:15, that was the lowest point we had on the 15-minute time frame. That's the low here. It gets rated here at 219, taken out. At this point, we're looking for any PD array, most likely a fair value gap that breaks the swing high to go long. If not, you'll see other PD arrays print that are going to support price higher. So either a volume imbalance, right? When two candles don't touch, something along the lines like this, right? A volume imbalance, or a order block theory. You get a breaker, you get a mitigation block, you get a rejection block. You're going to see some fingerprint that the algorithm is going to print for you to find a potential long setup. Listen to the keyword. I said potential, because that same PD array that you may be banking on may fail. That setup may fail. Nothing is 100%. You have to take responsibility knowing that any trade that you take can fail. Always keep that in the forefront of your mind. Any trade that you can take can fail. So don't just go out here risking 4% per trade, risking 3% per trade, knowing that you psychologically can't handle taking a 3% loss on your account. Don't do it. Take responsibility. See that volume imbalance? Look at that. Respect it. You can even see a down close candle before the rally up, right? Price coming down, tapping right back into it. Let's keep playing it forward. You can see a volume imbalance here. DXY really funky on the 1 minute. Volume imbalance here that runs through what? Swing high. So that same analogy here, right? There's a swing high formation. There's a volume imbalance that is in between that, right? That engulfs this swing high. So it's almost very similar to what? The inefficiency of the fair value gap here. This candle opened, ran all the way up here, came back down here. But then the next candle opens all the way up here. So it leaves a gap and it reprices that. And then we'll possibly see price go higher here. Right? And where is that PD array being printed? In a discount. It can't be random. It's rigged. I want everybody to know it is rigged. The sooner you come to the realization that this market is fake as hell, fake, it's all fake. It's not supply and demand, right? Depending on your methodology and what your belief system is. Because everybody has different beliefs. Some people believe in Wyckoff. Some people believe in ICT. Some people believe in Larry Williams. Some people believe into all these other things, right? It all depends on how you believe in the market. If you believe the market is rigged and coded, odds are you're going to see things that are very meticulous and just very strange at certain times, at certain price points, at certain kill zones, on certain days. Price action is doing something outstanding, right? That some people just can't understand or fathom. Like, why did it do it on Tuesday? Why did it do it exactly at 8:30 every time? Why did it do it exactly at 3 a.m. every time? Things like that is why I believe the market is rigged, because I see things like this. Play it forward, play it all the way through. Look at that. So look at how simple we went from sell side to buy side. And look at how we framed it from the 15-minute time frame. Out of all the liquidity pools that I could have marked up on other time frames, I went straight to the 15-minute and said, I'm taking that swing high. Let's go back to the 15-minute real quick. There it is. That same 15-minute swing high, price returns right back into it. Very strange. But we know that things like this occur. If sell side is taken out, what is the only thing it has left to take after or destroy? Buy side. Not guaranteed, because the market may have made up its mind to go lower, right? Higher time frame premise might say it might continue going lower. So London produces some type of pathway to go short, which is most likely taking out a high and then going lower. But if dollar is long on the higher time frame and you see somewhere in London session that sell side liquidity is being taken out, and you know from the daily, weekly, and monthly that DXY should be going higher, that the month of February is showing higher price action day after day. Swing highs being broken, higher swing lows being printed, higher swing highs being printed, and you get an opportunity for the day, intraday, on any given day, right? Now, I'm not including, okay, news events, right? Red folders or medium folders. I'm talking about in a broad sense. Any given day, you see that London takes out counterparty liquidity to the higher time frame, so price is going up. Counterparty liquidity would be sell side because in order to go higher, it needs to liquidate sell side liquidity. Point blank, period. Vice versa. If you see that the higher time frame, daily, weekly, or monthly, is telling you that it's going to be bearish and you're seeing lower swing highs and lower swing lows, and you see counterparty liquidity taken during one of the kill zones, which is going to be buy side, you're looking to go short to take out sell side going in that higher time frame trend. You want counterparty. I want all the retail traders to go short. The algorithm may allow them to win, and I might take the loss on that, which is cool. But I know eventually the market makers, the algorithm is going to print a false break. I'm trying to catch that every time because it's the easiest thing for me to see. It's night and day. It's a simple thought process. Instead of me thinking, oh, continuation lower, I can simply just take a neutral standpoint and say, I want to catch false breaks every single time I'm in the market. I want to be opposite to whatever anybody tells me in the chat. Someone sends me, oh, I'm short UJ. Well, let me just buy just in case, just to see what happens. And not saying you should do it, but if you wanted to, in a little side experiment, start a small chat with your friends, whether it's 3 or 5 guys in the chat, right? Whoever it is, and send an analysis, right? Or have your friends or buddies send analysis like, oh, I'm going long, or I think gold is going long, I'm going short, right? And go opposite to them and see what happens. And you will see how funny this is because when there's a buyer, there has to be a seller. And when there's a seller, there has to be a buyer. One of you guys is going to lose, and one of you guys is going to win. And then you'll start to see whose speculation is a little closer to the truth, who truly understands price action. Sell side, buy side. Very simple approach here. Where did we buy? Discount. We went in the discount. Let's just check it out on a 5-minute time frame just to see how it looks. So on a 5-minute time frame, we actually got a volume imbalance mixed in with a fair value gap. So you got here, here, and you can see here. Look at that. Entry point here, boom, price goes long. Interesting, right? You also got what? A down close candle. Down close candle, and then price running up, right? Market break. Price is changing directions. Price returns right back down into that order block. There you go. Boom. That order block is specifically in a discount. This order block is not up here. Oops. This order block is not in a premium. It's not up there. It's below, guys. So this is something I did struggle with when it came to finding PD arrays early in my career. Where am I buying? Where am I selling? Well, you want to buy cheap every time. Every time you're looking for a buy, you got to buy cheap. So hopefully that makes sense there. So let's move on to the next pair. So that was the dollar weekly breakdown. Just to look at it real quick before we move on. That's what it looks like. Weekly open. There it is. And ever since that long down there, you can see our price trends all the way up into Monday. That was, look, where's Monday? Yeah, the Monday's here. So trades all the way up to London close. And then price starts to turn around. It consolidates again. New York lunch period. We know that that's a dead zone. And then it continues to consolidate in Asian session. I wouldn't trade dollar, of course, in Asian session. It would be pretty ludicrous to do so. And then you see it drop down, rally up, consolidate again, rally up, fill in inefficiency, fall back down. Huge buying opportunity again here. Consolidates all the way through the rest of the week. A lot of funny things happen this week because the video, I'm not sure if you guys watch stocks as well, but NVIDIA all-time highs, profit breaking highs, earnings hit. Stock market is on fire right now. So those that do know the correlation to fiat currency and stocks, they generally are opposite. So if the DXY is going higher, we shouldn't necessarily see higher stocks. We should not. And if the DXY is going lower, we should see higher stocks. But right now, the correlation is off balance, it's off whack. Stocks are just flying, all-time highs, all-time records, all-time profits. So something is bound to happen. We all can kind of feel it and see it going on. Inflation, the banks talking about cutting rates. So a lot of things are happening and occurring. We're living through history, as you guys know it. So moving on, we got UCAD, same thing. Weekly opening price. Just look at how it's teeter-tottering back and forth. We take this off the chart. It looks like nothing, right? Looks like completely nothing. But as soon as we put one price line on this chart, it kind of gets you closer to the truth. You start to frame scenarios in your head. You start to see, oh wow, they brought it up and then they brought it low. And then they brought it from low back to high. Look at that. That just that one line. Without it, with it. Look at that again. Take it off. Looks like nothing, right? The average trader will look at this and be so perplexed. They'd be like, I don't even know what you're talking about. This is too complicated. But then when you tell them best buys come above premium and best buys come below discount, then they're like, ah, aha, now we're getting somewhere. And this week, we're going to be talking about 3 days for UCAD. We're going to be talking about Tuesday, the New York model, Canadian dollar, or Canada had its inflation rate dropped around, I think, 9 o'clock or something like that, or 8 o'clock during New York model. And you're going to see how this model would have set you up to catch this. So pay attention. So we're going to start off with Tuesday. We're going to go into the New York model. In the New York model is going to be incorporating a dead zone, another dead period. Yes. How many dead periods are there? There are three dead periods. Two of them are very short, and then one of them is very long before Asian session. So from 5 a.m., this is the second one, 5 a.m. to 7 a.m. right there. That's the kill zone we're using to trade 7 a.m. to 10 a.m. So if we were to bring this back right to 7 a.m., we're just looking for a liquidity pool here. This is the London lunch. And like I said before, it's 5 a.m. to 7 a.m. New York Eastern Standard Time. No trading is permitted here. Unless you're like a really good scalper or you're experienced here, then I would say, hey, with all means, do what you want. But if you are inexperienced or in general, like even if you did have experience, I still recommend not to try and find an intraday setup here. It's just not rewarding enough. It's most likely going to be another phase of consolidation, or what I like to say is market sentiment buildup. It's building in buy orders and sell orders to prep itself going into the next session. So while retail traders are losing their mind for these next 3 hours here, right? They're losing their mind. They have no clue what's going on here. They're losing their mind because it looks like it's buying and then it's selling. And then it looks like it's buying again and then it's selling. So just totally avoid trading here. There's no point to trade in this session at all because most times to not. I would almost bet almost 8 times out of 10 you're gonna get consolidation here. Same thing for the Asian lunch session that I showed with DXY. You're gonna find yourself in consolidation. Do not trade there. These are rules I'm trying to tell you so you become a better disciplined trader. You have to follow certain parameters to find success. If you keep breaking rules and keep chasing price and trading when you're not permitted to trade, you're not going to find success. You can't even owe it to yourself to be profitable. We're going to be looking for all the buy side and sell side liquidity that is residing here. At times, it's either the highest high or the highest swing high or the lowest low or the lowest low we have or lowest swing low that we have. So we can see this is the lowest swing low we have. So that's going to be sell side. Very simple idea. That's sell side liquidity. Then we're looking for buy side. So we can see these are double tops, and we'll take that. We'll take the double top. Doesn't have to be a swing high. We'll take a double top because what does retail look at this as? Resistance, right? They think price won't punch through this. They think price they think price is going to hit this and respect it. That may not be the case every single time. So we're going to use that. Equal highs normally is going to get cleaned out by the market. Too easy. Too easy to not want to look at this and see price go right through it. So that's going to be our buy side liquidity here. Put it there. And that's all we have. Two levels, one for buy side and one for sell side. Sometimes it's multiple levels. There's still other swing lows that are unbroken, and there's still other swing highs that are broken. It comes in different fashions. Every day is not going to be the same, but they're relatable, right? They're like cousins. We're going to wait to see what happens going into the New York session. We're not trying to jump the gun because that's what most undisciplined traders do. Soon as the session starts, they're itching to make money. They're itching to make money. You will make money. Let the setup come to you. Stop forcing the trade setup. Retail traders, I just know it because I've done it before. I'm a victim to it myself. I'm not saying I'm perfect. Deontay is not a perfect trader. Early in my career, when I had less discipline and less, guidance on what the market was doing, the session would start and I would just see it go up. So I'm like, you know what? I'm just gonna buy, some type of PD array, buy, buy, buy. And at times it would cause me to get into big wins sometimes, right? But then there'd be other moments and times where I was not winning at all doing that same unrealistic model, just chasing price. If it started selling and I saw in the 5 minute or the 3 minute or even the 1 minute, because a lot of new traders like to watch the 1 minute and they don't really know what they're doing and they just sell because they see three candles going down. 3 minutes were down. Okay, next candle has to be down, and the next so on and so forth. That's not the case. The market is going to come in cycles. And at certain times, the market's going to gyrate really fast, especially if you have news events. That news event, price is just going to wait and stall, 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 stall. And let's say the news event's at 8:30. It stalls. It probably is slowly in the slope going up or slowly in the slope going down, or it's just consolidating straight across, holding price. But that in itself is manipulation. The fact that there is time being spent, wasted, just dilly-dallying back and forth. They're wasting time for the news event to drop. And then they push it somewhere. Then they push it this way, or whatever the case may be. To play it forward, it goes down. See, retail traders would see that. On the 1 minute, this looks like a crazy sell-off, probably, right? Because we go on the 15-minute time frame. This price leg going down right here. Retail traders will look at this. No context, right? No context. Let's say we're not even looking at this sell side liquidity pool because I gave you guys the context basically, right? Let's say we had no context and we're just looking at the market like this. Most people that see this just by itself are going to look at this and say, "Oh, optimal trade entry." They're gonna let me grab a fib, put the fib down here, man. Let me wait for price to go back to OTE and then sell. I used to do that because I had no idea what I was looking for. I had no idea how to frame the ideas or when I should be looking to use a fib. If anything, in this case here, I would use the fib going up now with the context that I have. And I don't use Fibonacci retracements or OTE setups no more. I used to do that stuff. I don't do it anymore because I just found other methods to be more feasible. You don't have to take everything that someone teaches you into your trading model. There's so many different models out there outside of, what I mainly know, ICT. Outside of what I know, Larry Williams. There's so many other ways to be profitable, but I'm not going to take every single thing to apply it. Moving forward, now we're just waiting for a swing high to be broken. What a fair value gap. Sorry, I couldn't get the words out for some reason. You can see right here. Let's keep waiting. This is Monday or Tuesday? I'm looking at Monday. I apologize, guys. It's supposed to be Tuesday. Let's keep playing it now. Since we're here, it's supposed to be a Tuesday example. But since we're here, looking at it here, see sell side is taken out. We'd be looking for a long setup. Okay, I realize this is not Tuesday. We have no fair value gap here that takes out a swing high. None at all. So we just left a discount going into a premium. But notice when we get those down candles, look at how price is reacting around them. Are we getting huge displacement away from down candles on the 1 minute? Yes, we are. We get, after breaking this here, this down candle is completely engulfed to the upside, even to a point where it breaks what? A swing high formation on the 1 minute. But notice the context. This is from the 15-minute swing low. Now we're looking at a 1 minute market break here. Price is coming up. There is one fair value gap down here that we could potentially say, oh, that's the one we're looking for. If you go on my channel and you look at the New York session model on my channel, if you click that video, the entry technique is telling you, the one that I was telling people when I made that video, was to take the very first fair value gap that forms after taking out the liquidity pool. That's counter to what you're looking to go for. So if you're looking to go long, that means you're looking for sell side to be swept on the 15-minute time frame and a fair value gap to the upside below fair value or 7 a.m. opening price. This would be the entry technique. You would go long, one-to-one scenario. That's what I used to also say about the Asian session model and the London session model. I refined it to a fair value gap that breaks a swing high. This can still be a feasible setup. I'm not telling you it cannot be. It's just something I personally, Deontay, I don't prefer to take it anymore. I want to stick to one idea over and over again. I don't want to be wishy-washy with my entries because the more simple I have it in my brain, the less I have to worry about panicking about, oh, could this also be an entry? Could this also be an entry? Yes, a lot of things can be entries. But what is the entry that you particularly like to look for? You have to make up your mind on that. Play it through. Just play it through because I'm not entirely sure how this played out. But I wouldn't be surprised if it follows price action structure. See? So this wasn't even the example I was looking to show you guys, but we happen to just flow with it anyways. Sell side taken, buy side taken. Night and day, guys. It's not going to happen every day. But I just show this over and over again every Friday because I want other people in the community to slowly reinforce the idea that trading can be simple and you don't have to do a whole lot to find profitability. You don't have to do a whole lot to find successful trades during your day. Some people would use optimal trade entry, right? Like I said before, let's say we wanted to use optimal trade entry. Oops, sorry. Let's go down to the 1 minute. Right when we get that market break, right? When we finally get a bottom, quote unquote, and I'm putting that in quotation marks because we don't know necessarily if that's a bottom, if it's going to remain this swing low here. But it's a swing low. So we know we can anchor a fib at the bottom of that until we get what? A swing high. And then price respects that swing high, at least trades inside a range. So let's bring it back right here. How would we use the fib here? We wouldn't use it like this anymore because we understand the context. You know, new me would have been looking for a sell setup, right? Someone that's just getting into ICT concept or OT setups, they're just throwing a fib on anything. I used to do that. I used to be a victim of that because I didn't truly understand. It's not the fib, right? It's the operator. It's not the Fibonacci retracement tool. It's not the OTE setup. It's not the 70.5. It's not the 62. It's not the 79 retracement level. That's the magic. It's the operator and how it's being applied. Anybody can sit here and draw a fib up, but will it actually respect what you're looking for? Maybe not. So let's just draw this out. So we got a range now. And this range is a swing high and a swing low. And I'm not trying to get very specific in how you draw the fib because many people may say, oh, why don't you just use the bodies instead of the wicks? Let's say for this example, we're using the wicks and we're going to stick with that, right? If you want to use the bodies, go ahead and do so. I can't control how you want to view the marketplace, guys. I can't. You got to make up your mind on those things. Sometimes someone else can't tell you exactly how to do it. Looking at this, we have a premium range. Let's code this out. Premium range, sorry, a discount range and a premium range. Get close to it. It's close enough. I'm going to mark this in red. I'm going to keep the discount range in blue. So we got our fib retracement level. So in between, that's 50%. Play it forward. Let's see how far. Because let's say the swing high is broken again. That means we have to readjust our fib until it gets back inside to seek for internal liquidity. That's the only way we would have to adjust it. If it doesn't break that swing high and it drops in here, then we wait. We patiently wait. But if it comes down, makes this short temporarily top, right? And it comes up and breaks it again, we have to re-anchor our fib from this low to that next swing high until it drops down. Then we look for the entry. So looking at this, what can we do? We could use that PD array matrix. We're going to be looking for what? Certain PD arrays that are either going to be in a premium or a discount. Like I said before, we had this here. We had that fair value gap. Let's not mark it off with a. Let's mark it off like this. We have this one fair value gap here, a discount fair value gap. We know for sure it's a discount fair value gap because of the range that we're trading in, high to low, and plus it's below 7 a.m.'s opening price. And also a bonus, it's below what? The weekly opening price. So you got multiple confluences here. It's the operator, guys, and it's the way you read the price action. We also have a down close candle here, which could also be used as what? Bullish order block theory. So let's just highlight this here. So go fair value gap, last down close candle before the engulfing candle there, and the market break. There we go. So we got some PD arrays here. We can also flip it on the other side. We can also use the fair value gap that failed on the opposite end, right? So this fair value gap here could also be used on the other end. So this to this, and we'll change this. Now the chart's getting a little messy, which is what I don't like, but it is what it is. But we'll change the color. Red is fine. So this fair value gap that failed, right? So this fair value gap was not respected here to continue going lower, to give that continuation lower. Did not respect that. Instead, price runs right through it. And we could be using this as quote unquote classic support or resistance. So if price were to return back into this, that could be an entry point. Let's play it forward. Let me just double check. Just any other PD arrays that I've missed out? No, I don't think there's everything that we have in a discount array. Price taps in, and now price goes higher. So it's the operator and understanding these small, subtle details. The little details add up to the bigger picture. In order for me to get that long or get any chance of opportunity to go long, I need to have context behind it. People have a lack of understanding on context and actual market flow. I'm not saying I'm a master, right, at understanding price action to its fullest potential, because I don't. There's some things I'm still learning. I'm a teacher and a learner at the same time. I would never sit here and admit that I know everything about the market. I know enough where I'm comfortable and I've made up my mind to be concrete in the models that I like. And there we go. We just framed an idea. That fair value gap could have been the entry technique that you're looking for. Price goes higher. Price trades below 7 a.m.'s opening price. I'm going to ask the chat once again. What is the territory below 7 a.m.? Is that premium or discount? Just to engage with you guys, so you guys are not falling asleep listening to me. It's discount. Sorry if I beat you to the punch by typing it, but yeah, it's discount. It's discount. Good job. Good answer. It's discount. So you can see how it's rigged. The algorithm made sure to get the best buying opportunity to get up back up here to buy side. And I want to play it out just to see where it continues going on the 1 minute. So look, it takes out buy side liquidity and now gets back right back up to Sunday's opening price. Wow. Wow. Look at that. All of for this one idea, major pips. Now that's if you catch it, of course. Let's say hypothetically we did catch it and we got it to the, let's say we took it off of that failed fair value gap, that turn support right here, just to measure, see what we're looking at. So on UCAD, about 10 pips. Not bad. That's a good setup. If you're risking 1%, it's great. If you're risking 2%, better. As you get more confident with this, then you'll be able to understand how you like to risk, where you place your stop loss, the entry techniques that you prefer, and etc. I don't like to use too many entry techniques because it gets confusing. It gets very confusing. I can sit here and admit that it does get confusing. I want it to be clean. I want my chart to be very clean. But this is also a good example to show on Monday. The example I wanted to show you is the one that I'm preferring looking for. It's on Tuesday. So let's play that out to Tuesday. Let's go all the way to Tuesday. See, now we're above in a premium again. We're in a premium. Double check. This is UCAD Tuesday. Okay. So play it all the way through. We want to get to New York session. Look how price pulls itself all the way back down. Look at how it leaves London, or it is trading in London. 5 a.m. Boom, gets down here right before New York session. So let's mark that out. So we got 5 a.m. and we got 7 a.m. here. So we got our little dead zone, a mini dead zone here. And then we got our New York session. Play this one candle forward right here. This dashed line that you're looking at here on the chart right now is the weekly open. Don't forget that. What's this? This is sell side liquidity. Simple. What's above this high up here? Buy side liquidity. Is it broken? No. Nothing in the near future breaks that high. Nothing in the near future. Oh, my phone's dying. Nothing in the near future breaks that high. So that's why we're going to take that high right there and utilize it. Let's plug up my phone. Cool. So we're going to use that. We also have this high up here. We're going to take this high as well. So take that high. Now, we have our buy side and sell side framed up. And we also have New York session just starting. And as it starts, it doesn't run out any liquidity pools that we have marked off. It doesn't run out of swing high. It doesn't run out of swing low. And we'll just mark this off so we can see it. 7 a.m. open. And then we'll write out weekly open so we can tell the difference between the two. Let's play it forward on the 15-minute time frame. Because when I'm doing this live, I'm sitting here watching on a 15-minute time frame. I'm not jumping back and forth on the 1 hour, then the 4 hour, then the 30-minute, then the 5. I'm just sitting here on the 15-minute time frame the entire time. I have an alert sitting right here and an alert sitting right here. So that if I am busy, right, if I have to attend or talk to my brother or talk to my mom or dad or get on a phone call with my business partner, whatever it is that I'm doing that might take my eye off the chart for a second, I'm still prepared. I'm putting measures in front of me to make sure that I don't miss an opportunity. So what do? I set up the buy side liquidity and the sell side liquidity on the 15-minute time frame, and I place an alert on it, just like that. I can't do it because I'm in replay mode and this already happened, but I would click it, put a setup here, and I would type out the message. Sell side liquidity broken, for the message. When it pops up on my phone, it will come up and it'll say sell side liquidity broken. So that I already know instantly that I'm like, okay, I'm looking for a long setup. Or vice versa, I'll put the entry here, or the alert here. Type in buy side liquidity broken. So when the alert goes off and I get the message to my phone, it's going to say buy side liquidity broken. I'm not wasting any time. I know exactly what the market has done. It's not that I don't know what this alert is going off for. That's why I write the message. You can put an alert in here, but if you don't type that message in, especially if you have multiple alerts, you don't know what this alert is being triggered or what it's for, unless it's just one alert that you have set off. Multiple alerts, you need to put a message on it so you know what's going on. Let's drop down, see what happens. Boom. What's that? Raid right there. Purge. Boom. What are retail traders doing? Looking for some type of short opportunity here. Deontay's not looking for a short opportunity, especially while being below the weekly open. Right? The context. I'm cheap. I'm also below 7 a.m. And there's also news coming out today. So Canada's having the inflation rate drop. Settings indicator. Economic events. Here. At what time? 8:30. Specifically, they put that news event specifically at 8:30. Even on the days where there's not high to medium impact news, 8:30 is still a pivotal moment for the New York session in general. 8:30. Remember that time period. 8:30, 8:20 to 8:30. You're going to see something set up. Even a little further, 8:20, I will even go to say to 9, 8:20 to 9 a.m. You're going to see some type of pivotal moment in the market. Same thing for London session. Anywhere from 2:30 to 3 a.m. And if I had to give you an extra bonus, 2:30 to 4 a.m., you're going to see the market most likely pivot and change directions. Let's play it forward. See how here, look, price goes up. Let's go down to 1 minute while this is all occurring. Let's go down to the 1 minute. And what are we looking for on the 1 minute? We're looking for a fair value gap that breaks a swing high. Now notice here, this is that 15-minute swing low that's broken. We're below 7 a.m. We're below the weekly open. Here comes the context, guys. Context is coming in. Now, if you're confused at any moment, please stop me, right? Because this is going to be, we're not talking about a lot of topics tonight, but please stop me if you're confused at any moment in time. And please make the question relevant. Please. People ask me questions. What about you, Jay? I'm like, we're talking about you, CAD, guys. So look how that first fair value gap here, that very first fair value gap is broken. The very first one. It's not broken, sorry. It's traded back into. The first one that forms is traded right back into. That was my beginning or my first entry technique that I was telling the community that I was taking. And I was using it. And I was finding success with it. And at times, you'll see that it is still feasible. So we're just going to leave this on the chart just to show it. We can see here, this is the entry technique that I'm looking for. This one right here. Swing high. 1, 2, 3. That's a swing high. And then there goes that fair value gap right here. Fair value gap broken. So we're looking for price to return back into this fair value gap and go higher. How would we trade this, right? The parameters. What is it looking like? 1-to-1. 15, 15. Done deal. 1-to-1 scenario. See the one. Risking $1 to gain $1. I find that the 15 pip stop loss is a very sweet spot. It's almost like the golden ticket stop loss. Because I feel like when you have a 10 pip SL, odds are price can retrace enough and sweep a low by 5 to 10 pips in increments. I think that extra 5 pips just gives it enough room so that if price were to come back down here, I can withhold that and price can still come back and give me potentially get me out a drawdown and for me to break even and then potentially go into profit. I don't like smaller stop losses unless it's a scalp opportunity, unless I'm really trying to be conservative in the profits I made in previous weeks or beforehand. That's the only reason I would use a stop loss smaller than 10 pips. Waiting, price hits it there. Boom. Now we're in long right there on that candle. At 8:07, we're long. Remember, the news is at 8:30. So we're already in before the news, based on this model at least, and the way it's setting up. We're already in the market. Our entry is where? Below weekly open and 7 a.m. We're in a discount, guys. Discount parameters. Let's play it forward. And even then, so if we were to take any swing high to swing low, right? Let's just start measuring ranges now with the fib because we have the context. We're looking for a long. So we're not going to set our fib like this, looking for a short opportunity from here, here, into here. No, we've got the context already. We're looking for a long scenario. So that is completely out of the water. We're looking for a long. So we would set our fib to a swing low to swing high. Something along the lines like this. Let's bring it back. So we're on the 1 minute using a fib. Look at that. The range high, the range low. Cut that in half. 50% of that range. Looking for what? A discount PD array. Same thing I was just showing you, right? You're looking for your PD array matrix. 50%. We'll make this one blue. And then we'll make this one red up top right here. right? Premium discount. What are you looking for? You're looking for, if you're looking for the long, you're looking for discount PD arrays that fall below in the discount in the blue shaded zone. Let's take this off because we don't need the fib anymore. What do we have? We do have a fair value gap that's at equilibrium, right? It's almost cut in half, 50-50. So this can still be an option for an entry. You can see partially some of that fair value gap is mostly in a discount. So we can take this. We also have what? This last down close candle. That's a discount array. Order block theory. Here we go. Why would we call this, use this as an order block? You can see comes up, market break right there. Look at that swing high, it breaks. Price comes down and comes up and takes out a swing high, but it doesn't run through that swing high with speed like the other entry technique that I'm talking about. So you can see there goes a long position here. And when we throw the fib on, you can see it gets really close, I think, to 62. Or does it? It does hit 62, I believe. Just move this over so I can see it better. It just got close to 62% retracement level. Very close. So you can see you can use other analogies here and blend other things. I know I'm very quick to show you the same entry technique, and it's not that there's just one. There are a plethora of them. You just need context. We'll leave that on the chart there so we can see that. But when we play it forward, we get this fair value gap that runs through a swing high here. 1, 2, 3. And even all these clean highs too. Runs right through them. Runs up, which is great. We want to see displacement. We want to see price moving higher. And then we want to see price return back into it. Price returns right back into it. And let's see what happens right around 8:30. Hits the weekly open. Look at that. Hits the weekly open. Turns right back around. Turns right back around. Fills in some of this inefficiency, this liquidity void here. Turns back around the weekly open. Very interesting. Keep playing it. Boom. 8:30 comes out. Boom. Gone. It's gone. Can't catch that. Retail traders are chasing at this point. They're looking to go long. They're just taking off scraps at this point. If you didn't get the long down here, you're just eating crumbs, which isn't bad. You know, you're just eating crumbs. And you can probably still chase price and potentially come out a winner, but it's very dangerous to do that at this point. Very dangerous because what metrics are you working off of after price gives you this large candle? Not much. Everything is kind of washed out. Everything is kind of reset at this point because we just now taken out sell side right back into buy side. So the last three examples that I showed you. So we showed the DXY London setup, right, on a Monday. We showed AU London setup on a Thursday, and then we didn't get into AU yet. UCAD, we showed that Monday setup on New York session. And look at here. Tuesday, New York session, same idea, same premise. Sell side, buy side, guys. It's not that complex. But we need to understand the framework and how we're trying to base this on. Is the higher time frame trend telling us that UCAD should be going higher? It has been. Those that have been following, the tracking for this month, for February, we've been tracking the yen crosses. And when the yen crosses go up, that also technically means dollars going up too, because yen is opposite to DXY. It's a very complex system. If yen is going to drop, DXY is going to go up. And then also all the yen crosses are going to go up. Though, if the yen crosses go up, that does not mean the majors like AU, GU, EU, NU, did I miss any? And NU are going to go up as well. That may not be the relatively case as well. But we do know if the dollar is gaining strength, that means the base currency here is dollar, it's gaining strength. That means the quoted currency should be losing strength. It should be weakening. We should not see CAD futures going higher. So if you were to put this side by side, see if we can find CAD futures. Scroll down, CAD futures. What day is this? This is, I'm going to have to match it up. Do this quickly. 15-minute time frame. That's Thursday at 7 a.m. Thursday. You can see it right here at this drop anyways. Here. Just to see what was happening there intraday. So go here. Oh, way too far. Leave it 9:30 because that's when it opens. Futures. A little different. Go on 1 minute. Tuesday, no. I'm always doing that. Thank you. This is why. Thank you for those that are paying attention here. I'm doing stuff like this all the time, fam. Always doing stuff like this all the time. I'm only human. I'm not perfect, you know. You guys see me do silly stuff like that. Like sometimes I'll upload on YouTube like the wrong video. Like I just finished recording a video, but I'll upload the video from yesterday instead. Like I do stuff like that all the time. I don't know why. Um, Tuesday. Yes, thank you. Thank you so much, Bubbles. Appreciate it. 20th. Right here. We'll bring it back right here. 1 minute. Settings. I'll play this forward. Oh, I want to play it out all the way to like 3 p.m. That's where the future is really close. 3 p.m. Cool. That's fair enough. So we can see it was declining. Nathy looks disturbing, of course, because it's futures. It's not FX, but you can see how it's looking to go lower. I don't trade futures, but I use it to help me understand what the pair that I'm looking at most likely is going to do. But we can see that UCAD shot up right here at 9:30, and we can see right here at 9:30 open, completely sells off right off the open, right down. Doesn't even give anybody the opportunity to get a premium sell for the futures. Right here's the opening price. Just drops. Opens, drops immediately. Nobody got a chance there. If I got it, nope. Yeah, drops out the open. So that's how you can use futures to help you understand what the price is going to do. If you look at it from the daily time frame, of course, lower time frame, it starts to get a lot of carnage, a lot of noise, quote unquote. This looks much cleaner though. But notice how we frame that idea here. Even trades right back into what? That original fair value gap again. And trades back into what? That same order block again. Perfectly too. Price comes down, closes on that order block, right? On that open of it. Then the next candidate opens exactly on the order block, trades a little lower, then runs back higher. No chance for retail traders to catch that. It's too quick. Too quick. In that 1 minute, right? Now we don't know exactly how it shot up. Like it might have shot up in 30 seconds of that candle, then it kind of stopped. And then another couple 10 seconds it shot up and it came back down and shot up and came back down. Just taking the guess that it shot straight up in 1 minute, right? Or very quickly. Retail traders are caught off guard. And at this point, they would chase price. So let's see what happens. Like with that idea and context in mind of them chasing price, let's see what happens after you go long chasing it. Right now we're going to this is London close now, right here. That's London close. Odds are what happens during London close. You might see a reversal play out from 10 a.m. to 12 p.m. In a 5 minute. I'm not sure exactly what happens, but we're just seeing. It's in a premium. Consolidating. Look, another dead zone. Look at how we're just consolidating. Wasting time. Just wasting time. This is nothing, guys. Market is not doing nothing. Good luck trading that. Asian session comes around. That's where you see that move here. Asian session comes around. Wednesday takes out Tuesday's high. Got news, FOMC, and everybody that was looking to go long After that huge push up, slowly that optimism of longs disappears again. Look at that. Everybody that was long chasing this higher, right? And they're looking for great rewards higher. But all the market does is dilly dally after this large candle. Just does nothing. Whole bunch of nothing. Drops, even runs up a little much, and then it finally sells off. This is why you can't chase price. Just because you see a large impulse to the upside doesn't mean you get in here and start to jump into FOMO. Markets are very psychological, right? It weighs a lot on our mental, and it can drag us down and lead us to the wrong path. Now we have a Friday London model. Let's jump into Friday. So I'm showing examples on different pairs. So every week, it's not the same pairs, different pairs, of course. Because many people ask me, the most famous question I've been getting lately is, what pairs should I use this model on? And that is up to you to decide. I can't tell you which one to use because I haven't sat here and back tested every single pair and which one is the best, right? The best to use for this model or this kind of idea of using the dead zone. I haven't figured that out because I don't trade during those time periods. I'm sleeping, most likely or not, or I'm taking care of business outside of trading. So it's up for you to figure out if EU, AU, GU, NU, UCAD, USwissy, UJ works well with the London or New York model. The same way I went back and I started back testing UJ for the Asian session model, and now I'm only sticking with UJ. It's the same way you can do the same thing with pairs as well. Before, those that knew me, before I went public on YouTube and stuff like that, they've known that I was trying to figure out the Asian session model with all the yen crosses. I was trying everything. I was trying GJ. I was trying CJ, I was trying some weird crosses, and I had a good pal from Australia. Shout out to Julian. He was like, don't waste your time on all the other crosses. Just focus on the main crosses like UJ. And I stuck to UJ, and man, UJ's been hitting ever since. The other crosses, sometimes they're hit or miss, but they do run a lot, and it's a really risky thing to trade per pip. Like the spreads on some of those crosses are ridiculous. So we got our sell side here, and we got our buy side here. Let's play it forward to see what happens. Boom, price instantly runs out. Actually, no, this wouldn't be the sell side. Sorry. So this is a good example. So notice here, right here. So this swing low is already taken out. This one here, 1, 2, 3. We can't take this one here, guys. We can't take it. Why? Because this candle breaks it already. We can't take it. So we have to wait. And we're going to either wait to see if this is going to be the swing low that we use, or 2 a.m. is going to come down and take it out, because we saw that 2 a.m. comes and takes it out. So we have to take the end of this 2:15-minute candle, right? 2:15. We got to take this candle's low. Whatever that low point is between 2 a.m. to 2:15, that's going to be our sell side liquidity pool. It's not a swing low, but it's the lowest low we have via 2 a.m. on the 15-minute time frame. I know it says 2 a.m. here, but technically this candle ends at 2:15. We're on a 15-minute time frame. Just go down to the 1 minute. We got the opening price here. Look at the precedence to it. Look at the respect to it. Look at how it opens, closes right on it. Opens on it, runs away from it. Taps into it, runs away from it. Really strong precedence to the price action. Play it forward. Price sweeps it right there. Boom, sweeps it. You can already see the entry technique. It's right there. Right there. Look at that little fair value gap. Here, here. And this one, in this example, is the first one that forms after breaking that 207 low between 2 a.m. and 2:15. That's the lowest low we have. So we use that, hits it. But we can see how it's also the first fair value gap, but it's not just the only fair value gap by itself, meaning it runs a swing high too. It's not just because it forms first after the break. It forms first, which is just a coincidence, but it also happens to run a swing high. It runs two swing highs. Now, it doesn't have to run multiple swing highs. Once it runs one swing high, that's good enough. This swing high cannot be at the start of the fair value gap or the end of the fair value gap. It needs to be in between the 2 points. So whether that's a pip higher than that or a pip lower than that, it just needs between this shaded area. It can't be at the starting point or the ending point. I don't take that as an entry. So just making you guys understand that. So here, I will look to go long. Same idea. One-to-one scenario. We can also see in this risk to reward ratio and the projection that we're using for 15 pips, we can see it gets us back to weekly open, which I like. It also gets us back to that buy side liquidity, equal highs on the 1 minute. You can see how it's transcribed to being looking at as equal highs or double tops, and it was double. It was a double top. Yep, double top here, and we're waiting for price to trade right back down into it. Let's play it forward. There it is. Price trades into it. We would look for what? A long setup. Look to go long. There we go. Now, many people may say, but I endure drawdown. That comes with the game. It comes with trading. Your entry technique is not your entry point is not always going to be the end all be all turning point, right? It's not always going to hit the fair value gap and then fume fly away. You will endure some drawdown, and there will be a better entry because if it turned around below in a drawdown, that means there possibly a better entry. But it's okay. You're not always looking for the best entry possible. You're looking for a quality entry. And the quality entry was you brought below 7 a.m. Period. Done. Done deal. Right? That's the end goal that we're trying to get. No ifs, ands, or buts about it. Full stop with a period at the end. Right? We're looking for a quality trade. Done. And then price trades away. You can even see this is what a balanced price range. Right? It's not something I would use. I'm not versed in it. Few flies away. Facts. Is that what I'm saying? I say few? Yo, I'm weak. Yo, I'm gonna be listening back to these videos, man. I might be saying some funny stuff. So, yo, I'll crack me up. Balanced price range here, right? You got two fair value gaps down, two fair value gaps up. So what happens here? Sellers are trapped. They trap the sellers here. Sellers are mad. You know, mad. Sellers are mad for sure, fam. You know, so at that point, you look to go long, it flies, and you reap the benefits of that. Other people will probably argue, right? Probably say, "Oh no, I'm looking for a sell setup," right? But you already have in mind what the higher time frame is looking for. You know that UCAD on the higher time frame is trading higher. So just to show, something like that, USD CAD, just to show what UCAD was doing on the daily this week or more in most recent time. We can see it's looking to trade higher, right? We even had a raid here on Thursday, and it trades right back up. And that's what we saw here. Coming down, price running back up below the weekly open. So that's UCAD. So hopefully you found that insightful. And the last pair we're going to look at before we jump into the next topic is AU. So we want to look at something that's inversely correlated. So I always like to incorporate pairs that are correlated. Normally it's always going to be the DXY and the major UCAD U Swissy, and then I'm going to use anything inverse like either AU, EU, GU, depending on what examples I find to be a very teachable moments. And I'm really proud of a lot of you guys too, for sure. I'm proud of you guys for one, soaking in the information and utilizing it and showing other people in the community, right, in the Telegram channel that, I did find profitability with what Deontay told me, or I did find a successful setup, or I saw a potential setup and I demo trade it. It doesn't have to be live. You don't get no bragging rights, whether or not it's live or demo. Once you're able to get and understand and execute the trade, I'm proud of you. I'll clap for you all day. I'll give you your flowers. I definitely want you guys to comprehend it. The sooner the better, of course, but take your time. And another reason I'm proud of you guys is that you guys are slowly picking up on how simple it can be, right? Many people aren't that versed in trading in general. We have all different, trading experiences and years in the game, but some people that have little experience in the game are taking the ideas that we're talking about here tonight and applying it and seeing a lot more success than they've ever seen before, which is something I'm really proud of you guys for. So just want to let you guys know that, I am paying attention to that. I may not react to everything that you guys post, but best believe Deontay, like, people think I don't check the chat. Bro, I'm checking the chat every day. I wake up, bro, brush my teeth. I'm reading the messages, bro, making sure nobody's saying anything. The bots that come into the chat, try to delete the stuff. I try to keep it tip top. I may not comment on everything because it ain't up to me to comment. Y'all grown men, y'all can talk about what y'all want to talk about, but just be cordial and respectful. It's a safe space for everybody. I want everybody to win. So just remember, I am watching. You don't be telling people off and writing people off, and have some thick skin, Feel like some people be a little soft sometimes, a little sensitive, bro. Like, you could take some constructive criticism at times, It's all good. It's all love. AU, so weekly opening price, premium discount. Look at where the best buy is coming from. Right here. Where? Discount. The best sell in this week was here Thursday. Right here. Highest point. Look at that. 3 a.m. Like I talked about earlier. Look at 3 a.m. right here. 3 a.m. Look at that pivotal moment in London session. London session for entire hour, at least from where I started, for 2 hours, right? I started at 2 a.m. For 1 hour, it was all the way up until it got to 3 a.m. Then it turned right back around. Very interesting. So it has to be rigged. So we're going to be looking at Tuesday, New York model. So this model is a failed example, but I'm going to show it anyways because it's good to show you that even when you think all odds are in your favor, it can still fail. So it's very humbling, which is why you got to take responsibility and how much you risk. Because even when you think you got it, the market will say, give me that every time. And you'd be like, dang, man. But you got to risk properly. So this setup was a fail one, and I just want to show it because it's a very humbling moment, even for me. When I take a Asian session, you think I win every single Asian session model? No. Think about it. If every single Asian session model or every Asian session that we have during the week was successful, we would be on episode 2000 by now, but we're not. So keep that in mind. And I'm only showing the successful examples because it gets straight to the point and what I'm looking for so that people can understand, okay, this is what it looks like and this is what the model successfully looks like. But do know, of course, they're not winning every single time. I am taking losses too. I have to mitigate losses too. I have to lower my risk as well. Sell side, buy side. Done. We're done. Now, this is a good one too. So we wouldn't take this one. We would take this one. The reason why we would take this one is because before 7 a.m. opens, this one is still available. So the 7 a.m. candle or the 7:15 candle runs up and takes that one out. So we're using this. Instead of framing it and saying that this is the highest high, we had a swing high rated at 7 a.m. So we would take that. Someone asked me a question about how to gauge that, and that's how you would gauge it. Hopefully that's not too confusing. If you still have questions on that, please hit me in the DM. I got you. We can go over it multiple times. Play it forward. We're in a premium. Weekly premium. We're above midnight opening price premium. We didn't even talk about that either. See that? We're above midnight opening price, 12 a.m. We're above that. We're above 7 a.m. So a lot of confluences saying that we should be looking for sells because they're overbought territory. No indicators. 1 minute time frame. Looking for an entry technique. That's the 15-minute swing high that was rated. clean highs, relatively equal highs, runs it out, and we're looking for a fair value gap that runs a swing low. There we go. So we got it right here. So there's a fair value gap. Correction. Is this one? Let me just double check. Nope. So you see this one? This is a good example. We wouldn't take this one. Why? Remember what I said before. That swing low cannot be at the beginning of the fair value gap or the end or the end of the fair value gap. I'm just being picky, of course. This is me, me being picky. I don't want to take that one because at times I see that this one fails me and I don't like it. And other times it does present a good setup. I just don't want that one because I don't want it to be too much differentiation between, oh, am I taking this one, Deontay, or this one? No, every time you see the entry, it's going to look exactly the same. I don't want it to look different. That's the only reason why I'm sticking to it. This can be used as an entry, but I don't want to do that because I don't want to switch up on how I was showing it. So we're still watching price. We're still watching price. Play it out. See, price even goes higher. See, even with this, see, it even runs back higher. Puts me into some drawdown. And then you can see right here, fair value gap here. There goes that swing low. Price runs right through that. That's your entry technique. We're going short. Price trades right back into it. Short. One-to-one scenario. Remember, we're on AU. There we go. Looking to go short here. You can even see the projection for our TP is putting us in range of fair value back to 7 a.m. Also the sell side liquidity points. So I like that. Let's play it forward. See what happens. Drawdown. Loss. Loser. You take a loss. So even though we had everything hitting for us, everything checking boxes for us, we still took a loss. Now, many people may say, well, why is that? What was the reason, Deontay? I can give you a reason. Trust and believe. I can sit here and conjure up some, I'm putting this in quotation marks, excuse to say why I got stopped out. But that's not up to me to explain to you why I got stopped. We got stopped because we got stopped, period. Done. Full stop. At the end of the sentence. When you start looking for not excuses, but technically is excuses. When you start trying to justify why you got stopped out, you're only doing more damage to yourself. Be objective. Do not be subjective. There could be a plethora of reasons why this trade idea got stopped out. Plethora of reasons. You may get that reason right. But then what about the other reasons that people may come up with that said why they got stopped out? They may be wrong, completely out of what the market was doing. So don't try to justify why you got stopped out. You took the loser, next trade, bro. It's all good. Why is it okay? Because we have no fear in losing, because I know that you're going to be a responsible trader when it comes to trading. I know that after listening to me or listening to others in the community that are doing justice to the community, that you're going to risk properly. You're going to manage your equity well. You're not going to blow an account. You're not going to blow a challenge account. You're not going to blow your funded account. You're not going to blow your live account funds. You're not going to do any of those things because you know at any point in time when things look perfect, there's always that 1% chance that the trade can fail. Now, speaking hypothetical, it could be larger than 1%. But even when you're 99% sure, there's that 1%. So that means even in the back of your mind that you know that the trade could lose, you should also keep in the forefront of your mind that you should be risking. Don't be going ahead and thinking, oh, I'm going to bet the farm here. I'm going to risk 6% of my equity here. And then when you take the full stop, what happens when you take that full stop? Your brain just fries. Just fries, bro. What are you doing? Revenge trading. I can make it back, bro. I promise. Man, I could get us out this hole. Right. And then you see people on community forums, right? On social media platforms asking other people, like, yo, bro, I'm down 6% in this count. You think there's any hope with me to passing the prop challenge, or you think I can save my funded account? I'm so down and drawdown. You think there's any way? There's a possible way. You got to really risk small at this point, and you got to really climb out that hole. It's going to be difficult. But why put yourself in that predicament in the first place? How did we even get to 6% drawdown? That's ridiculous. How did we even get to 4% drawdown? 5% drawdown. You're risking too much. Telling people these things because it matters. I'm passionate about it because it matters. I want to see you guys succeed. I want you guys to, get all your wishes come true, help that person that you always wanted to help in your life, your why, whether that's your daughter, your son, your mom, your dad, your cousin, whoever it is, your best bro, your best sister, whoever it is. I want you guys to succeed. That's why I'm telling you guys these things. I'm not trying to steer you down the wrong path. I would never give you guys advice that I wouldn't take for myself. Never. I would not do that. Any advice that I give you guys is exactly what I apply to my strategy or my lifestyle as a trader or my trading journey. Doesn't mean Deontay is always going to be the same trader. You know, 5 years from now, maybe my entry technique does change. Who knows? And we saw it did change because it was the first fair value gap that forms. And if I would have stuck with that, I would have been stopped out much earlier. So let's say I took the very first fair value gap that formed after breaking that swing high. It would have been this one here. It would have been that one right there. I would have been stopped. So I had to readjust. I had to tell myself, wow, man, this entry is wishy-washy. Sometimes it hits for it, sometimes it's not hitting for it. So every time I keep trying to run the play, it's not really consistent enough for me. So I had to switch it up. And I went for this entry. I found that this entry technique was a lot more consistent. So that's what I'm going with now. So things as you learn and you progress, you will change as a trader. Change can be good. Doesn't mean it's bad. Me changing my entry technique was for the better, in my personal belief. And we'll play it out just to see what happens for the rest of the session. There you go. That's the life of a trader right there. And we got. Did we get TP? Yeah, we did. We hit TP, so we definitely hit TP. It's like right around here in this candle. Yep. So, like I said before, that's the life of trading. It sucks. You got it right. You got the entry. You waited. You spent, hours, not hours, but you spent a couple hours potentially waiting for it, and you got stopped out. And then later on, you come to check, it actually went in that direction and took out all sell side liquidity. That's nasty work, man. You gotta love it. You can't hate this. You can't hate. If you hate this, stop trading. I'm telling you, if you hate this stuff, stop trading. You got to love this. You cannot be trading. You hate this. You gotta love this enough. Like I said, you can't be trading this and hating this. You gotta love it because you already know with the information that's out there that nearly 90% of traders are failing. So for you to pick a career to jump into knowing that 90% of people are failing, that's almost ludicrous. People will tell you, man, you're just better off just getting a 9 to 5, which most people are. Most people are better at sticking at a 9 to 5 because they can do that much more easier, right? They're good at taking directions. They're good at being a good employee, etc., etc. Whatever that comes to, they're good at that, and it's a consistent paycheck. Trading cannot be consistent at times. I want you guys to know that. But the fact that a lot of people get into trading, in my opinion, that I think is the autonomy, the freedom that it gives people, right? They don't have to necessarily listen to a boss anymore. They become their boss. They make their hours. They trade when they need to trade. And they could potentially, right? The potential to reward, it's almost infinite depending on your skill set. The highest paying job, being a trader is up there for sure. But the risk is high though. So many people will call you and tell you, yo, you're mad for trying to become a trader. Because best and believe the default in this world is becoming an employee. That's the default. Anybody can go work corporate. Anybody can work a 9 to 5 retail job, cash register job, sales job. Anybody could do that. Couple interviews, maybe you got a degree or two, you got your associates, you got your masters, your bachelors, etc. Right? You could find a line of work somewhere. Best believe you will be able to find a line of work. You get a CDL, you start driving, transporting stuff, many means to make money. And that might be a lot more consistent for some people than it comes to trading. It's just a pure fact. People don't want to admit these things. Trading is not meant for everybody, right? But if you really want it that bad, you want it that bad, you got to love it. You got to love it because there's ups and downs being a full-time trader. It's not always peaches and creams. It's not. It's not easy. And Tuesday. There's Tuesday. Now let's go to Thursday. So there's the last New York model we're going to talk about. So we got Thursday, and then we're going to move on to lower time frame entries based on a Larry Williams concept. And this is one concept that I really love to use on the higher time frame. We'll talk about it on the higher time frame first, and then we'll talk about it on the lower time frame. Let's go to Thursday. Thursday's a London model, so we're going to go to 2 a.m. right here. So right here is our liquidity pool here. Yes, it's not consolidating, but we're still going to use it. We're still going to use it, even regardless of it not consolidating. It is ideal to see it consolidate because we like to see the market consolidate. And that key phrase that I learned from ICT a couple years ago when I was learning all this material, all markets start in a consolidation. I didn't get that at first, right? The 4 phases of the market. I didn't understand what that meant really. It took me a while to start to understand and conceptualize this. All markets start in a consolidation. And I'm like, so what? It starts in a consolidation. It sucks to trade in a consolidation because how do I make money? Right? It's just ranging up and down. So if I buy in a consolidation, I'm in profit, then I'm in drawdown. Then I'm in profit, then I'm in drawdown. So it's just a headache. I don't want to trade in consolidation. Doesn't make sense to me. I want to trade when it's moving. But when you start trading when it's moving, you start to get things wrong though. Right? It starts going up. So you say, oh, it's going up. It left consolidation. So let me just buy. Oh, it left consolidation down. So let me just sell. Sometimes that does work. Other times, I can count a handful of times where it doesn't work though. The market starting in a consolidation is ideal because it's a small range cycle. That same ideology that Larry Williams talks about, it's the same thing that's happening in a consolidation. It's a small range cycle. It is not volatile. There's no volume being heavily pumped into the market. It's range bound. It's less interesting psychologically, right? And physically and visually on the eyes. When you look at a consolidation, it looks boring to the average trader, right? The average trader that thinks like the average person, when they see a consolidation, it doesn't look interesting. But when they see the market moving, then they're like a little enticed, right? Like, oh wow, it's starting to move. Okay, now I should be looking for some break retest. Or I should be looking for some type of pattern, ABCD pattern or whatever retail traders talk about, I don't know what they talk about, man. Um, and then they truly don't understand that they're just chasing price when all we're waiting for is consolidation. So it's okay that this dead zone here, the Asian lunch, doesn't start in the dead zone. We still want to use it because it can still help us with a setup. But it's nice to see when it's consolidating because that's when you start to see, oh, I have a banger that's most likely going to happen because the market's going to now turn from a small range, right? Consolidation, and then boom, large range. That's what we're looking for. That's what I show almost all the time. That same little scratchy thing I just drew up, that's the setup I'm looking for. If I had to draw it on the back of a business card, that's what I would draw and give to people. They were like, "How are you profitable?" I would draw this. I would draw that little thing. I would draw this. That's how I'm profitable. Deontay's looking for the sell up here, or vice versa. Deontay's looking for this down up, looking for the buy down here. So that would be my model if I had to draw it on the back of a business card. That's it. Play it forward. We can't mark this off yet because we don't truly know if we got a swing high yet. So that's why you got to wait a little bit. So here, so we don't get a swing high. So we got 2 15-minute candle. So we're taking that. We're going to wait to see which side is broken first. Odds are the fact that price is really close to this already going into 2 a.m., it's going to run this. More times than not, it's going to run the high than look to go short. It's a rare occurrence when I do see it do this instead. Instead of running this high, like up like this, and then it goes all the way down here, and it comes back up here. It's a very rare occurrence. Not saying I haven't seen it do that before. I've seen patterns like that before. But most times than not, it would run this, then go short. I've just seen it hundreds of times. So now we're waiting. We can see here it runs that candle, right? Now we're in a premium. We're in a premium for London session. We're in a premium for the weekly itself, and we're a premium for the day. So we're above midnight opening price. We'll draw it out just for fun here, since it's the last example we're going to be looking at. That's midnight opening price, all the way down here. We're looking for what entry technique? Fair value gap that breaks the swing low. Let's play it forward. See why you gotta wait? You gotta wait. You gotta wait. Yes, I know it's running. I know. Have some discipline. I know it's leaving you in the dust. I know. But you're not in the trade, so you don't have anything to worry about. You have nothing to worry about. If you're not in the market, relax. Take it easy. Until the entry technique shows itself, then I would say, okay, you want to look for this idea. This actually might be a failing example because I see the fair value gap that breaks the swing low. So I've actually miscalculated here. So I can see here 1, 2, 3. There goes your fair value gap. Here. So we look for a shorting opportunity into that, and we can see it pulls us into a lot of drawdown. So if you were to set this up, I believe it looks like we would have been stopped 50. Oh no. Oh, interesting. Play it forward. Could have sworn it was this that I saw as the entry technique. So this here, this swing low here. I overlooked this one here. I didn't realize it was here. So just to show the one that I ideally thought was happening, it was this one. There you go. Look at that swing low. 1, 2, 3. Fair value gap right through that swing low over here. So you got to really look for it. It may not be the closest swing low. It might be a swing low that's a couple minutes away, right? Maybe 30 minutes away on the 1 minute. This one you can't take. Look at that swing low. Does it run through a fair value gap? Does a fair value gap run through it? No, it does not. So we can't take that one. That's not the one we're taking. You can even see it leads a large fair value gap here. Balanced price range. They trap what? The buyers in that formation. Fair value gap up, fair value gap down. Buyers are trapped. That's most likely what you're seeing happening when you see this formation up, down. Don't look to go long. Leave it alone. If you see this formation here, up, fair value gap, and a down fair value gap, odds are it's going to go down. Context, though. Got to have context. It's in a premium territory. Play it forward. See little to no drawdown on that entry. So that was the one I was looking for when I first was going back and just checking all the examples, but I missed that one. And we'll speed it up just for the video's sake, and it tears down. Whew, wow, man. That thing flies, man, going into Thursday. So it still was successful. A lot of drawdown, though. It's crazy. I didn't see this one, but this would be the entry. This would be the correct one. This would potentially be an entry if you were looking for another opportunity to go short based on the idea, the same entry technique, just a little higher. But you can see how this one pulls us. It's a lot of drawdown, and it would be painful. You know, most people at this point, they can't hold this. Why can't they hold it? Because they're risking too much. If you can't hold a trade to full stop, that means you're most likely uncomfortable with how much you put onto the trade. I've been there. I've done it. You place too much onto the trade. You think it's going to respect it and probably give you like maybe 5 pips down. And you'll tell yourself, oh, I'll get out real quick and I'll move my stop loss to break even. So I don't even care if price reverses and hits me out because I took something out the market because I'm risking 6%. And that 6% gain on a couple pip moves can give me, substantial amounts of money. And that's just in my opinion, you're just out here gambling, you know? It's not methodical enough. It's not objective enough. That's why I don't prefer to scalp because scalping can be very difficult and tedious at times. You got to really catch that turning point, because scalpers are risking heavy for a couple of pips to the downside or a couple of pips to the upside. And it only takes a couple of pips to the wrong side to blow an account, especially if you're a scalper. So scalpers are in and out, quick turnover rate. I like swing trading because there's probably a lower turnover rate like working for a job. This job has a low turnover rate. We don't fire a lot of employees here, or a lot of employees don't quit. That's how I view swing trading or position trading, because it's a lot easier on the mind, less stressful, and you have to be managing your risk well. Scalpers, high turnover rate. People quit this job a lot. People get fired a lot from this job a lot, because these people are looking for quick bang for a buck. It works for a lot of people sometimes. And sometimes it's luck. I'm not going to lie. Sometimes it's just situational. Time. It's time and pricing. For some reason, when this person decided to get into this market at this month, at this time of year, everything just happened to hit for them. Check, 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 check. And they make buku money. But let's say they did that a year later and they tried the same thing, they might lose instead. So sometimes it's situational. So that is our man. That thing sold off, man. Whoo-wee, man. That thing sold off, dog. So premium, and it went all the way down. So it continued to trade off going into the New York session. So New York session gave a continuation pattern. And I believe, if my mind is looking at it, this is AMD. Yeah. A very overstretched AMD though. So accumulation, manipulation, ooh, heavy manipulation. And then now here comes the distribution. We want to get back down to the Asian session low. If I play it further, odds are it runs the Asian session low. So close. And we'll pull back and then sell off. There it is. So Asian session low tagged. So accumulation, manipulation, distribution. Your classic AMD. Looking to sell in London above the Asian session high if you're going to be a seller. So that's just a little tip. Vice versa, if you're looking to be a buyer, you want to be buying below the Asian session low. And it would be flipped inside. So it would look like this: down, up, right? Or more precise and accurately, it would look like something like this. And get the high. That's the Asian high up there. And then down, up, something like this. Consolidates again, somewhere here. Retracement, right? Runs down and then goes up. Accumulation, manipulation, distribution. So that is your simple ideas for trading London and New York. So hopefully you find that insightful. So we're going to be moving on to smash day entry techniques on the lower time frame. So we're going to talk about it on the daily first, and then we're going to talk about it on the 1 minute, the 4 hour, and even potentially the 5 minute. But I mainly want to talk about it on the 1 minute and the 4 hour, and we'll see exactly what I'm talking about. Nah, you guys are funny in the chat, man. So let's go into. I don't even know which one I want to look at. Let's go to swing trade. Yeah. All right. So we're going to show this on the daily time frame. So Larry Williams smash day candle is essentially a turning point that catches a lot of traders off guard. For example, let's look for an example that's pretty obvious. A very, very obvious example. So this one here. Remember, just looking at UCAD, doesn't matter. This candle down, let's go back to when it finishes closing right here on the daily. Remember, it's fractal. It's a fractal idea. Everything you see on the higher time frame can be seen on the lower time frames. It's just easier to paint the picture on the higher time frame because there's a lot less data and the candles are a lot larger and the setup is so much more apparent in front of your face. It's just like large and apparent. You can't miss the setup. This is a smash day candle. Why is this a smash day candle? By definition, by Larry Williams, read his book, Long-Term Secrets to Short-Term Trading. If you need a PDF to that book, we can get it. We can hook you up, man. This candle here, its close is below lows. It's below several lows. So it's not just this low here. It's below this low, this low, this low, anything below it. So if we were to draw this to the left side, this candle, its close, it's way below a lot of lows. This in itself, to most retail traders, the way it looks, this looks like the sky is falling. And what do I mean by that? They think this thing is on a tear. It's just selling off. It's closing below lows. It has to keep going lower. It must keep going lower. But that's not always the case. There's going to be a point of time where the market does turn around. And Larry Williams, I believe, has the closest thing to catching the turning point, at least via daily, right? Because he's showing it in his book. A lot of the examples he was talking about was shown on the daily chart. Larry Williams likes to trade the higher time frames. He's a swing trader. You show a lot of swing trades. This looks bearish. Let's add another one. Looks bearish. I like when people say this too. I love when I hear other people say, it looks bearish. Once I start conceptualizing what the higher time frame is doing, and I start reading other people and what they're voicing their opinions about certain things, and I start hearing terms like this, I'm like, okay, maybe they are slowly getting the mass public to believe that this pair or whatever asset class is going to continue to fall out the sky, because most traders are average. It's not a bad thing, right? But most traders are average and they think average. They don't think outside the box. Most successful traders, they think just differently. Most of the most successful people in the world, like I'm talking about filthy rich people in the world, very unique brains, very unique intellect, very unique IQ, very unique situations, right? They most times going through high school and college and stuff, people called them weird, or they were, they dress funny, or they talk different, or they don't got this certain swag that people agree with. But for some reason, it made them stand out and they had an edge against everybody else. And I want you guys to find your edge. Don't think like the average trader. The average trader gets average results. We don't want average results. We want to be successful and we want to be profitable. This looks bearish. That's what average people would say. Just give this to a chart, right? Give a snap chart or a snapshot of this to anybody on the street, in your city or whatever town you live in. Odds are that person is going to tell you, man, that thing is bearish. It's going to sell. Which is probably not a bad educational guess based off of no knowledge or prior experience of trading. However, this can lead you to your demise, right? This could lead you to the wrong side because you think it is just going to sell off. In my mind, in Larry Williams' mind, in his ideology, this is an oversold condition. The candle is closing physically below a low. Now, in the book, he doesn't mention how many lows it has to close below, unless I missed it in the book. I read that book almost 5 times already, 6 times already. And I don't think at any point in the book he says how many lows it has to close below, or vice versa for the sell setup, how many highs it has to close above. He just showed that it has to close below a low. And I'm like, okay, cool, fair. And if price returns back to the candle's high, this is where you would buy. You would use a buy limit. Sorry, you would use a buy stop order. You would buy here at the high of the candle, because in that sequence, it's most likely what? Making either a bottom, quote unquote, or swing low. It's a turning point. Now, you may not get it exactly on the next day, might be the couple following days. But if you get another candle that opens and closes down like that, then this will not be where you would buy. It would shift. Everything would shift down one. You would be buying here instead, right? Because this candle closes below that low. So this would be the new smash candle. You wouldn't be looking at this one anymore. That's only if the candle closes below the low. Next candle here. Does this candle close below that low? No. So we don't have a new smash candle. It's still this one. We're still looking at this one. Next candle. Do we have a new one? No. So we're still looking at this one. Keep playing it. Keep playing it. Boom. Look at how we get to that price point. Right when we get to it, very close in proximity. It could have been any of these days, but for some reason on this day, Tuesday, ideal trading day, higher volume. Price comes in, runs right through it. Larry Williams calls this a smash candle. Now you can obviously see why he calls it a smash candle, because all the sellers have been smashed out of their shorts. Anybody that saw this day and was going heavily short the next couple days stop loss hit. Stop loss hit. Very unique idea when reading that book. And when you start to see it, it's like, wow, it's a turning point. It's a turning point for price action. And I'm not gonna look at any PDRAs or seasonalities or whatever the case may be, because it's 2024, but we know DXY was bullish for January. So it's very interesting to see how it set itself up here going into January. And we'll play it forward just to see where we are in current price. So just from this buy stop order, look at how this idea turns into a potential swing idea. Now, sometimes it could be short lived, and sometimes it could be very long lived. Sometimes price may not never come back down here. It could go on for the next 3 months going higher. And this was the pivotal moment. This one candle here gave you everything you needed to know. Getting closer to the truth. No indicators, guys. I didn't need an indicator to tell me that this looks bearish, right? Or is oversold. Price trades higher, away. So high away. How would you use this as stop loss in TP? Damn, how simple this better smash cam is crazy. I don't know why. Like someone said in the chat, just for those that are watching on YouTube. So someone said, damn, how simple this is smash candle on the daily. Why we make things difficult for ourselves. Plenty to back test on. Plenty. Oh my gosh. So much data to back test on, man. What makes that a smash candle different from any other down close candles? The close. It's the close. Look, the first thing I wrote. The close is below lows. Any other candle, like I said, all these were potential ones. Think about this. Like I said, if you get a candle that listen, you got to pay attention. Any other candle that closes below it would make this a new smash candle. So this was a potential smash candle here. This one here was the potential one. Don't look at anything prior. I know there's other examples here. We could sit here and backtest so many things because this setup happens very often on the higher time frame. Happens very frequently. Do not look at these ones right now. Look at this one here. This is a potential smash candle. Why is this a potential smash candle? What makes this different? Because this candle closes below lows. Look at where the close is, guys. The close is below all these lows. So if price returns back to this high, that's the buy opportunity. Does price ever get back to this high? No. So we obviously don't get the opportunity. No, it does not. It actually creates another lower smash candle. So we can't even look at this one anymore. We'd be looking for this one because this candle closes below the lows. So we look at that one. Now, the reason I picked that one is because of hindsight. I said we're going to pick a good example just to look at. No problem, my man. I'm glad I'm able to answer your question. So that's exactly why we were looking at this one. But at any point in time, all these become new smash candles. You would stalk the setup. You would keep stalking it until price gets back to that high. That's where your buy stop order would be triggered. Then you go long. Now, Larry Williams did not give. This is why I kind of have a bittersweet moment with a lot of people that do teach trading, because sometimes they don't give a full picture to parameters. And I can see why it can be difficult to give parameters sometimes because some things are very situational and some things are very unique at times. And sometimes some things depend on the equity you're allowed to trade and your leverage that your broker has given you and the actual setup itself. So from my experience and my knowledge, the way I like to do it in a very simple way, I would go long here. Let's bring it back. Right? The buy stop order would be sitting there at the high, and the stop loss would be at the low here. And I'm looking for a one-to-one scenario. So whatever this candle in size is, let me measure it out. Put that to one-to-one. There you go. So that's close enough. So that's what I would be looking for, one-to-one. Very basic idea. One-to-one, 50-50 coin flip. The odds of price coming up and hitting that is probably really high. Likewise, hitting the stop loss too. But we would favor the context of we're oversold and price is going to make a pivotal moment. So we play it forward. Are we in the trade yet? No. Are we in the trade yet? No. Are we in a trade yet? No. Are we in a trade? Yes. Look how dynamic that is. Smashes out all the sellers. That's the only reason why I think Larry Williams calls it a smash candle. Because why else would you call it a smash candle? It smashes out all the sellers in their buy stops. Next day, TP done. 1-to-1. Gone. Done. I'm glad you're having an aha moment. That makes me even more excited to keep teaching and explaining these ideas. And look at that. That 1-to-1 starts turning into what? A 2-to-1. And then that 2-to-1 starts turning into a 3-to-1. And that 3-to-1 turns into a 4-to-1. And then so on and so forth. The potential is endless. Like I said before, trading is a high risk career, but the potential of reward is almost infinite. Almost, it doesn't stop because at times it's situational. You can catch thousands of pips off an idea like this at times. And then people may ask, okay, how would you scale into this, or how would you take partials? The way I would do it, just for finally, once price gets to a PD array, or price gets to like equilibrium of a range, like from this high to this low, I'll probably take some partials off. Or if price runs into a swing high, like price breaks a swing high, that's an event where market makers can create a false break opportunity. So I would take profits there. So when price breaks a swing high, like say right here, price breaks up this swing high right there, take profit. Because who's to say that this price won't reverse back down? I don't know. So there's small tips to take profit at. General rule of thumb, if you're buying and price gets to a swing high, so like when I'm swing trading and price gets to a new swing high, take partials at that new swing high that it just broke. Take partials right there. Vice versa, if you're selling and price gets to a new swing low, take partials there and then try to continue to hold the trade. Sometimes or not, you may get stopped out. And it's probably pretty high that you will get stopped out. And it's okay because at least you took partials. At least you either met your requirements of that full take profit, TP1, TP2, whatever the case may be. And everything else after that is just a cherry on top. And you go on with that. So with this idea that I just showed you, very simple, that one idea, I know it's hindsight, but I just needed to show you that. So it's just a very simple, clear picture to you guys. This setup happens very often. Now, if you use it on a 1-to-1 scenario, it can be a banger. But if you're looking for it to use that as a trending environment, you may want to blend other concepts with it as well. So you might want to blend, seasonality, COT data. You might want to blend SMT divergent. You want to blend multi-market analysis, inter-market analysis. You want to blend those things together to possibly give you a better odd of maybe turning this from a short-term trade to a long-term trade or position trade. So let's take this down to the 4-hour, and I'm going to show it on US soil just to show that it doesn't just happen to currency pairs, Let's go on the 4-hour. Same idea. Now, I know we're cherry picking here. We're looking for an idea. We're cherry picking. We're looking for something. So for price to get up here, right? How did price get here? Well, let's look where we had a bottom, a very significant bottom. Okay, we can see right here. Let's take a look at what happens here to get to here, point A to point B. Let's go down. Let's go back here. I'm telling you, this setup happens a lot on almost every time frame. It's very fractal. 4-hour candle here closes below lows. This was I'm only picking the one. I'm cherry picking, like I said. This was the candle that turned right around. Got no sound on my end. Can you guys hear me? Somebody in the chat said they can't hear me, fam. All right, yeah. Sorry, fam. It might be your computer, my G. Thank you guys for letting me know. So here, 4-hour candle closes below a low. Like I said, Larry Williams did not say in his book how many lows it has to close below. He just showed in that small diagram on that page that it closed below either 2 lows or 1 low. And this candle, 1 is just enough to justify it, I guess. The fact that this candle closes below the low makes it a potential. smash day candle. So this candle here, entire thing, is a potential smash day candle. We want to see price return back to its high to buy, so we can place a buy stop order here on the 4-hour buy stop order. Where would we place our stop loss? We would place it at the low of that candle. That's what we want to place it there. So if you go long here, we really don't want to see price get back down to this low. So if we're triggered into the market long here and price returns back down here, not a good look, because then it would probably show us that odds are it's going to continue to go lower. We don't want that. So let's get out as soon as possible. That's why I'm picking the low to be my stop loss. Very quick scenario, in and out. So if we had to draw it up, it would look like this: long here, and then 1-to-1 scenario. Right in the 4-hour, it would look like that. Press play here. Right? Would we be in long? No, not yet. Does this become a new smash candle? No, it does not, because this candle does not close below any low. The close is right here inside a candle's range, so you won't take it. Play it forward here. Now we're triggered in long. Price opens. Now we have to go in a lower time frame to see it knock this in long first and then stop us out. Now let's just say in a perfect idea world, it didn't run up first and then run down to stop us out. Let's say it ran down first and then it ran up to trigger us in long. So we weren't stopped on the entry, on the trigger of our buy stop order. So now we're in long, and we hold, and we hold, and we hold, and we hold, and we hold. And there we go. We got a 1-to-1 scenario here. Then that 1-to-1 can turn into a 2-to-1, 3-to-1, 4-to-1, 5-to-1. And this setup is constant. It happens a lot. You can even see it here. Happens again. Let's just clear this out real quick. Clear. Right here. This is another smash candle. Just based on the definition of it. I'm not even overreaching what the definition is. I never like to twist people's words and what I learned. This is a close below a low, right? Or lows. Larry Williams would say, buy at the top of this candle's high. Now, if I had to optimize it, right? If I had to optimize it, I would buy at the open. It's a much closer entry and a much lower entry. So I would be long here. But there might be a reason why Larry Williams was saying buy at the high, because maybe if price had to get all the way up to this high, odds are that's really showing strong conviction that it's going to want to continue going higher. But if I had to optimize it and get an edge on it or get a jump on it, I would buy here at the open of that candle. So same thing, go long here, stop loss here. Same idea. 1-to-1 based on the size of that candle here. And we press play. Right? At this point, we're triggered in long. We're long. We hold it. We hold it. Hold it. Hold it. Hold it. Hold it. Hold it. Stop loss. I'm stop loss. TB. Stop loss. TB. Hit. That's a smash candle on the 4-hour time frame. So if I'm seeing this on a daily, if I'm seeing this first and foremost, if I'm seeing this on the yearly, probably less likely to see it on the yearly. If I'm seeing this on the monthly, for sure. If I'm definitely seeing this on the weekly, I'm definitely seeing it on the daily. If I'm seeing it on the daily, I'm seeing it on the 4-hour, so on and so forth. It's a fractal of itself. And then you'll start to see this same idea is happening on the 1 minute. The algorithm is turning price around that quick. That quick. So let's go back to some of these examples here. Let's just look at the pinnacle of the top of London session. Best believe odds are it was a smash candle. There's no other answer to it. Odds are it was a smash candle that turned price around. Guarantee you every time. Look at this. So it's inverse. So this candle closes. Is the 1 minute time frame. Just take everything I was telling you for that bullish setup. This is the bearish setup. This candle is closing above multiple highs. I'm cherry picking, of course, like I said. Cherry picking here. This candle closes above multiple highs. Look at how price returns back to the low. That's your short right there. Short there. What would you do? Same idea. Short here. Stop loss there. Now, I wouldn't necessarily look for a one-to-one because you're on the 1 minute. What I would do is do the same idea intraday. 15 pips for 15 pips. It is long-term secrets to short-term trading. It's in the Telegram channel. I'll share it with you after if you're in the Telegram channel. If not, we'll get you in the Telegram channel. We'll get you that PDF, my friend. No problem. So you can see here, one-to-one scenario for 15 pip, and that's it. And this same idea is what I showed you guys on UJ, I think another night. So I was in early on a setup, and that was it right here. So that same idea. I used a Larry Williams smash day candle to go short. So the entry, it was successful. The agent session model and the entry did form out. I told you guys I wasn't taking that entry. For those that know, no. I said I'm not taking the second entry because I've already risked enough here, max risk here. I was 5 lots in here. I didn't want to take another. I didn't even want to take another standard or one lot, and I held that, and I was able to get it right back down to what sell side. That same idea. I know it looks a little clunky, but look at it. That 1 minute candle. Let's get rid of this. That 1 minute candle here closes above several highs. It's also the candle, coincidentally, that breaks the 15-minute swing high. Not that it means anything, but I'm looking for the smash candle after, of course, the break of the 15-minute swing high. There it is. Price returns back to its low. I go short there. Short 15 pip for 15 pips, and there it is. So this entry technique can give you an edge because sometimes it is the exact turning point where the market makers want to turn price around, especially on the higher time frame. It can get a little funkier on the lower time frame, but on the higher time frame, I guarantee you that it is worth your while to look at for at least a swing trade opportunity or some type of position trade. So take your time, back test it, forward test it. Open up a demo account, test it out, test it on the daily, test it on the 4 hour, test it on the hour, 30-minute, 15. Test it on any pair, any commodity, any asset class, cryptocurrency, etc. Like crypto, let's just look at crypto real quick. The same idea. I'm telling you, all these markets are rigged, bro. It doesn't matter what we're looking at. We can look at crypto, same thing. Does that count? What about the higher candle before the break? Let me go back real quick. USD JPY. 15 minutes. Go back. It was around here. 1 minute. Refresh. So something about a candle where? What about the high candle before the break of the SDC? What's an acronym that you're using, Kenny? If you have the chance to. I'm so stupid, so foolish. Smash that candle. Come on, Deontay. Obviously. Um, which candle? So I'm looking at this one here. The one before on the 1 minute. Yes, this could be one. This could have been one. So think about it. I want you to look at this again. The other after. Sorry. Oh, after it. Yeah. There's also more that happened after. Yep, absolutely. So this one. Yeah. This is one too. This one here, right there. That could be one too. Right there. Price closes above a high. Whether it's one high, two high, three highs. Like I said, Larry Williams didn't really put a specific number on how many highs it has to close above or close below. But yes, this is a smash day candle, Kenny. Absolutely. Thanks for pointing that out. Yep. Hopefully that answers your question. So you go short here, right there. Short, you do the same thing. You go short here. I would recommend on the 1 minute, 15 pips for 15 pips. Because I feel like that 15 pip stop loss is just the golden ratio to at least adhere some drawdown and not get knocked out of the trade. I think 10 pips would be easily knocked out. So you see here, short. Same idea. So hopefully that makes sense. Yeah, it's so simple it's scary. I know. It's so simple it's scary. It's like when I saw this on the daily, man, I started looking for this everywhere, my man. Everywhere. I was like, man, like was like, who is this guy? Because I remember ICT would say he got mentored by Larry Williams. Now, I'm not sure if that was like private mentorship or public mentorship or whatever the case may be. However, he learned from Larry Williams. I was like, wow, if I, in some essence, right, look up to this dude that I think is a successful trader as well, or is able to educate me on the market to find success, and let me look into the guy that he also studied as well. So I went outside of ICT and said, yo, let me look into Larry Williams a bit. And his YouTube channel, if you guys want to know his YouTube channel, is called I Really Trade. And right now, I think Larry Williams has, I don't know, current date. I think Larry Williams holds the record to the Robbins Cup. I don't know if that's FX or commodities or futures. I think it's commodities. He holds the record, one of the records for the Robbins Cup right now. I think nobody has broke it yet. Larry Williams. So if anytime you guys have available to research other traders that have, made profound strides in the market or in the community, I totally would ask you guys to look into Larry Williams. Like his insight and his knowledge on the market is like well worth a gold mine. Because one, I think he's well into his, I think 80s or 70s. I'm not even sure how old Larry Williams is. He's 81. So you telling me this guy has years of experience underneath his belt? Shout out to Larry. Shout out to Larry Williams. Like really, like let me see. Let's see what he's got. Look, $1 million only using $10,000. Man, that's crazy, bro. And that's the book right there. Right there. Anybody want to know? That's the book I'm talking about. This is the book I'm talking about. The second edition. I also have this too. How I made millions of dollars last year trading commodities. Yeah, see, and I knew it was commodities. Yeah. I haven't gotten around to read this book, and I should. That's what I should do this weekend. I should start reading this book. But Larry Williams, I would totally will tell you guys to look into this too. So I have both of these books. If you're in the chat, we can get you this book like ASAP. We can get you this book ASAP. I know it's on Amazon for probably like 50 cash. We got you with a PDF free. You don't got to pay nothing. I'm trying to add value to you guys as much as possible. My channel, of course, Asian Session Library. I think we're at episode something. I don't even know what episode we're on. Like 38, I think we're up to. I gotta drop another video. We're technically on episode 39. I didn't get to record it yet, but get the word out, man. You could trade Agent Session. Everybody's doubting that you can't trade Agent Session, but I have literally 38 examples of successful models. So if any candle closes above, somebody in the chat said, if any candle close above or below the last smash candle, then the previous one is invalid and look for, yes, exactly. It's invalid. Look for new one. So that new candle basically becomes your new smash candle, like I showed on the daily, right? That new candle becomes a smash candle. So, for example, let's clear this off. We're on the this doesn't matter. We're on the 4-hour. Let's say at this point of time, like I said, I'm cherry picking, guys. Let's say this is your current potential smash candle, but then all of a sudden you get this. Are you still going to be looking at this candle as your smash candle or this one? You're going to be looking at this one. You can't be looking at that one. That's the new one because this candle is closing below that low. So this becomes your new smash candle, and vice versa for any sell setup as well. So, for example, see this candle here? Price comes up, closes above the high, but then this next candle here runs all the way up here and closes up here. This one's really large. So there might be still more optimizing. So the price even returns back to its low. You can see here and sells off. But here within itself, you can see another one. Look at this. This candle comes up, closes above this high, goes short here. There you go. So hopefully that answers your question. So yes, you'll be looking for a new smash day candle if the next candle closes higher than it or lower than it, depending on what you're looking for. So that's that 1 minute entry that I was trying to show here with that smash day candle. So if we look at any other session too, like choppy, so we won't look at that. I want to look at ones that have a Judas swing, a manipulation, and then a sell-off, right? Just look at the peak, the turning point. That's why I love it. It's like, and that's why on my YouTube channel, I call it the turning point. because in my mind, it looks like the exact turn of when the market likes to make the swing high or a turning point. You can see here, look at that right here. Before this sell off, look at this sell off here. This is a good example of what you were just asking too. Notice all these potentially become new smash candles. This one closes above the high. The price doesn't return back down to it. Right here. Right here. Potential smash candle. Right? Potential new smash candle. So you're not looking at this one anymore. You're looking at that one. Keep going. So you got a new smash candle. Oh, no. Actually, no. You're not. You wouldn't. Let me see the close. No. So you're still looking at this one. So you wouldn't be looking at this unless the close is equal. Closes 65, 5573. High is. So this one's still higher. Sorry, the close is below this high. So you can't be looking at this one. This is still your current one. So now this becomes, so this was your current one. Now this becomes your new current smash candle. Keep trading. New smash candle. That's a new smash candle. And then boom, finally smash candle unleashes itself. Here, here. You're in short. That's a potential opportunity to go short. One-to-one scenario. If you're looking for it, one-to-one scenario, go short. Same thing here. Look at this. Every time there's a turning point, it's almost no defying it. Like that's the smash candle. Here, it makes it look overbrought and looks like it's gonna turn around. It looks like it. That's why I said it looks bullish. Looks bullish, but then it turns around. It gets you. It gets everybody on the wrong side. It makes you psychologically start thinking, oh, it is turning around. Because sometimes it comes by way of 3, 4 candles, 5 candles up, like this one. 1, 2, 3, 4, 5, 6. And then people in their mind are going to sit here and say, no, it's turning around. Let me go long. And it's almost as if they're looking right over your shoulder, or they got a camera in your room looking at your phone or looking at your laptop, and they're screen sharing, and they know exactly when you're about to click buy. You go ahead, click buy, and then they dump it on you. It's rigged. It's so rigged. The highest point too. So let's go to 5 a.m. Let's play it all the way to 5 a.m. There we go. The highest point of this London session, you can see it's here. And it's also a smash candle right here. This candle closes above highs. Multiple highs. Doesn't matter. It closes above multiple highs. But look at how that candle price returns right back down to it and sells off. Now I'm cherry picking for the best entry, of course, the best case scenario here out of all the smash candles in this example. That would be your best one. Not saying you would have picked this one out, but just showing you the ideology and the methodology behind what Larry Williams is talking about. It's very fractal. Even if you didn't get the best one, let's say this one here, right? This one here comes up, closes above. But we need context, of course. So I would add in what? Did we break 15-minute swing highs on the left? Then we look for the smash candle that forms. So the timing of it. It's not that the session just opens and immediately right out the gate, I'm looking for the smash candle. No, I want it to be in a premium. Most likely, I want that. So, ICT has PD arrays, right? We could call this a PD array that Larry Williams has, right? And this is where I think, I could be wrong. This is where I think ICT kind of got the order block theory from. I could be completely wrong, because I know ICT was definitely influenced by Larry Williams in some of his teachings. He said it himself. This is where I think the order block concept or theory came from with Larry Williams smash day candles. It literally almost looks like an order block too. Look at it. It's a candle that closes above highs. It's most likely going to get engulfed, if anything, or if it's not engulfed, there's a market break or shift after it forms, and price trades right back into it. So if you draw this out, look how price runs away from it, trades into it right here, and then trades away. Same thing over here. Let's say this smash candle here. Order block theory, up close candle, price runs down, price trades up into it, down, up into it, trades away. So this is why I think I could be wrong. ICT Mike will have to tell me himself that, yeah, I was influenced to make the order block theory around smash day candles. Just my educated guess, because they look very similar to me. And that's your lower time frame entry idea for all the kill zones or even a scalp opportunity. but all the kill zones in general. And once you've seen it, you can't unsee it. So it's very hard to unsee it. For me at least, 'cause I see it all the time. Like here, there's one right here. Look at this whole leg down, this entire leg down in this price action. I know it's a dead zone, but notice how this candle closes above multiple highs. It even is the candle that is above the Asian session. So if you had to sell, it would be ideal to sell above the Asian session. Look at how the algorithm brings itself right above the Asian session high, creates that smash candle, and turns it around right there. So it would look like this. 15 pips, 15 pips. There you go. Wow. Like, it's pretty impressive, honestly. It would be a lot trickier, I would say, on the 1 minute because you would want a lot more context going into the kill zones, but use the same ideas. Use the dead zone, use the 15-minute swing highs and swing lows, and then see if you can find this entry technique the same way I used it here for this. So I waited for that 15-minute swing high to be broken, then I looked for that. I went short there, right on that. Short on this candle right here. So it was like that in a one-to-one scenario. And that's pretty much it. So if there's anything confusing or anything you guys would like me to answer, please ask me now. Because we went through all three topics. If you guys want to hear my insight on probably what's going to happen with the DXY or the higher time frame and where we are currently in price, I can go over that as well if anybody wants to go over that. If not, I'm going to take a Q&A and we're going to enjoy the weekend. And if you are not off from work or off from whatever you're doing, enjoy your day tomorrow and be safe. So if you have any questions, let me know. I will give you guys about like 2 or 3 minutes type of question or anything you want to recover or go over again. And yeah, no problem. Oh, my laptop's about to die. Let me grab that, plug that in. Word. I'm glad. Oh, go for it. Oh, that's what you said. You didn't say got it. Go for it. Okay. All right, got you. That's the reason why I put it up anyways. So DXY, quick scenario, right? Very clean. You guys know I'm a very simple trader. I'm not sitting here over analyzing this market. So right now we had this weekly swing low that formed in December, going into now where we can see that rally. This is a smash candle. Look at that too. This is a weekly smash candle, guys. Look at that. That's a weekly time frame smash candle. Look at the close. It's below lows. Price returns back to the high. Look at where it is now. Come on. It's everywhere. These ideas are very simple, but a lot of people aren't preaching it or teaching it. They're going to teach you all the most complicated ways. Market make a shift, market break, then go back, then 90-minute cycle, then, quantum theory, distortion. Bro, tired of that stuff, bro. Tired of all that stuff, bro. Nonsense. But yeah, smash day candle here on the weekly. See that close below the low. Price returns back to the high. Go long there. Higher time frame. You can see price runs back to a swing high. Buy side liquidity. So it made a swing low formation here on the weekly. 1, 2, 3. Turns around. Those that are also versed in high probability scalping, you can see there's a high probability scalp scenario in here. It's on the YouTube channel if you ever want to know how to find it. But right now, I see that price is trending higher. So we can see that price broke this swing high. Right, price creates a buy side liquidity pool, runs it out, keeps trading higher. Now, after breaking that swing high, I would want to see a higher swing low come into play for dollar because if it's bullish on the weekly, based on this momentum, bullish momentum is what I call a swing high being broken, or it's a false break. There's only two scenarios to this. It's puzzler to finding trend. It's either a false break or it's going to continue in that direction. It can't get more simpler than that. It's not going to be another third option. Is it a false break or is it going to continue in that direction? In order for us to confirm if it's going to continue in that direction, we want to see a higher swing low form, higher than this weekly swing low. So we play it forward, and we haven't gotten any yet. We also broke another swing high here. It looks like double tops, but it's not. This is just 1 pip lower. This is 1 pip higher. So there's a swing high here. But we need a higher swing low to form. So we keep playing it forward, and now we got a down week. Now, if this market is bullish, right, and with the education and knowledge that I have, I know in bullish trends after a down day, a down week, or a down month, that it's ideal for buying conditions. Because look at this. You had one down week. After this small range down week, look at how price expands. 1, 2, 3, 4, 5 weeks of bullishness. 5. Not 1 week, not 2, not 3, not 4, not 5, but 5 weeks of bullishness to target this swing high. Can't be a coincidence that it started buying after this down week because it's trending bullish. So if it's going to continue trending bullish, I'm assuming right here a higher swing low is pending. So this is me taking all of my IQ, right? Right, all of the information, education that I've learned over the years, and trying to forecast what price is going to do on a higher time frame based on a simple principle of higher swing highs, higher swing lows. The weekly is most likely creating a higher swing low. So it's going to look something along the lines like this. I want to see a candle. Oops, make it green. Form like this. I don't want it to take out that low. But if it does take out the low like that, then I would continue to say, okay, is this still going to be the swing low that's still pending? Because that means the next candle would have to do something like this, right? And make this the new higher swing low. So sooner or later, it's going to form. To try and get an edge on that, I would jump on the daily to understand what's going on. So let's go down to the daily now. And we also created what? A buy side liquidity pool again. So the market's always creating and destroying liquidity pools. So on the weekly, it created another liquidity pool here on the weekly. Go down to the daily. Now this is where I put the false break at. I said that dollar, I said in the chat recently, I saw that dollar and some of the majors like NU, GU, even gold was looking to shift bullish again, unless it's a false break to the upside to then go short. And then I saw DXY doing the same thing, breaking lows, swing lows, and potentially being a false break or bearish momentum. So I would like to see if price is going to respect this break and continue selling off, telling me that March is going to continue to sell. What the heck? That March is going to continue to sell lower. Swing low broken. Is there going to be a lower swing high that forms? Yes, there is one that formed. It formed right here. There goes the lower swing high on the daily, at least. That's a daily lower swing high compared to this one here, the one that we saw on the weekly. So it's a weekly swing high and a daily swing high. This one here is lower than that one, and it's after we broke a swing low. We also have a volume imbalance here. You see price runs all the way up to it, hits it, and then sells off. Hits it right there. Phew, sells off. Here, lower swing high forms. And then we break in a swing low. So is price continuing to go lower? Or is price just creating a false break? Trading into what? Maybe this down close candle here. This bullish order block theory to possibly go higher. And you'll notice that when price trades into PD arrays, it makes a swing low on the PD array or in the general area of the PD array. So it'll make a swing low formation on this bullish order block and then go higher. Or it would create a smash day candle, right? On this order block, close below several lows and then go higher and turn around. So that's what I'm looking at right now for the DXY. So I'm trying to see whether or not price is going to go higher for the DXY. When you look at other correlated pairs, right? So let's say look at UCAD. What is UCAD doing as well? What is it doing? It also recently in time ran a swing low. Ran a swing low right here. So the question is this a false break or is this bearish momentum? Right? Is this bearish momentum or is this a false break? In order to know if it's going to be a false break, we would like to see if price is going to return back to a swing high. So all of that breaking that swing low is just a bluff. It's just a bluff to get everybody short. Because if it gets back up here, it's most likely going to continue going higher. That's what we saw with all the yen crosses. We talked about that. We saw a lot of the yen crosses do the same thing. False break on swing lows, goes back higher, and then it continued trending higher for the rest of the month of February. Same thing applies to any asset class you're looking at, any currency pair you're looking at. So it's good to see that dollar and UCAD are doing the same thing. Then we look at something inverse to it. What do we see here? We can see that AU just recently broke what? A swing high formation. We had one here. We also have one here. While breaking that first swing high, 1, 2, 3, we got a higher swing low in that formation. Look at that. Let's get these red so we're not confusing ourselves. So we got a higher swing low compared to this one here after breaking a swing high. So this could be bullish momentum and the confirmation, 1, 2, 3, to continue trending higher. So there might be a change in trend here. So the bottom, we could already know that this was the low of the month because the month is about to end in a couple days. We got 1 week essentially left. So unless in this next couple days, next 5 days, price is going to give us some large candles to get back down here to take out the monthly low, which is probably unrealistic and unideal. Price is probably already bottomed out for the month, and now it's turning away from the bottom. And you can also see here too, what is this candle, guys? You can't unsee it now. What candle theory is this that we talked about by Larry Williams? This candle right here. If anybody is still paying attention. It begins with an S. Smash. There you go, Bubble. Exactly. Bubble's good answer. So you can see prices going higher. So price is continuing to go up. Smash day candle. It's right there in front of our face. We just don't see it. And then I see this as what? An order block theory. It's so interesting because when I analyze this, I'm like, this looks like an order block because price comes up, right? It doesn't engulf it in one candle, but it eventually engulfs it in 3 candles. 1, 2, 3. Engulfs the candle. Then price trades down into this candle here. Let's say we're taking the open of the candle. Trades into the open of the candle after it's been engulfed. And then it trades away. So I'm like, did ICT get the order block theory from the smash day candle theory? It looks so similar. But yeah, you can't unsee that after you see it. Once you see it, it's already in your brain. But AU is showing signs that it's going to trade higher. Now, we would have to look at seasonal tendencies. We would look at macro analytics. We would look at COT data. Not hugely focused on COT data. I don't use COT data. People ask me all the time, do you use COT data? Do you? Not really. I'm being very honest with you, being an open book. I don't use COT data. When I'm trading Asian session model, I'm not looking at the COT data between dollar and yen. I'm not. COT data in itself is already a lagging indicator. The data that you get is a week late. It's a whole week late. It's not like they're telling you on the day of how many longs and how many shorts they're getting into. Now, I know there are probably a few guys on YouTube that do a good job on breaking down the actual COT data. And I think they probably do a way better job than ICT and the way they describe and break down the actual numbers and how the orders are added or subtracted. So do your due diligence. But me personally, I don't use COT. If you don't hear me talking about it, I don't use it. It's out of my trading model. You don't have to use a lot of things or every single tool available to you to find success. Gold recently too. I was talking to my friend and Julian, my friend in Australia. Down close candle. Look at this. Down close candle. Phew. Flies, man. I keep making that sound effect. Slidy's got me thinking now. I'm so self-conscious about it now, man. Down close candle, price runs up. So you got that Larry Williams is the GOAT for this, bro. Small candle down, bullish trend, price runs up. Not saying you would have known that this was a bullish trend, but you can see how after this down close candle, there was some type of institutional buying. It ran straight up. And it's a large candle too. So very interesting. We just broke a swing high. So this is where it starts. This is how I start the trending formula. Caution sign. That means pay attention. Something's going on. What just happened? Step 1. This is exactly how I find trend. And I just keep following it. Sometimes it leads me to the wrong side. It gives me a false break and I'm caught on the wrong side. I just readjust. Swing high broken. That equals what? Bullish Momentum. Definitely didn't spell that right. 2, higher swing low needs to form to confirm higher trend. That's it. Now, could we look now taking that anticipated educational guess here? We can see it. Is this going to be the higher swing low? So is Monday next week going to confirm or give us that higher swing low formation? So this is a pending higher swing low. It's pending. We don't know yet. Now, unless something else I look at gives me an edge, then I can probably be a little more aggressive instead of waiting for step 2. But for those that are inexperienced and want to wait and want to have more confidence, I would wait for the higher swing low. After getting another candle that forms just like this, you got your higher swing low. It's confirmed too. It breaks this candle's high. That's a confirmed higher swing low. More confidence in that. Then every single day going forward, look to be a buyer. Very cookie cutter approach. Look to be a buyer, especially after down days, especially on Tuesdays, even Mondays too, but mainly Tuesdays, Wednesdays, and Thursdays. Look to be buyers. And if you get a down day going into an ideal day, buy. If you get a small range day going into an ideal day, buy. Buy where? Below discount, below weekly open. Look for those same models we talked about earlier in this lesson tonight to dictate where you want price to go. Look for the New York session model. Look for the London session model, the Asian session model to follow in trend of the higher time frame trend. So if gold is going to make a comeback, that would only mean what? Dollars potentially going to sell off. And we'll see. And we'll talk about what pair we're going to be trading next month. I have to go through a filter process, but if there is any in the smash candle, did we use the candle closes at wicks? We're using the wicks. Larry Williams in his book shows the wicks. I'll share the PDF so you could do your due diligence on that, Lenny. But if there's any other questions before we go, please let me know. And if not, I'm gonna end it here. U.S. oil, man. U.S. oil was bullish at the beginning of the year, man. Very interesting. Balanced price range. Looks like they trapped sellers. They're probably gonna pump this higher. If all this war continues, and especially around the Red Sea, if all that stuff continues, stuff is going to be wrong. So, especially a candle that forms in a swing is more promising. I would say so. Yes, Kenny. Yeah. In a swing formation, yes. You see it here. See that right? See this one right here? I know it's hindsight, but look, it's a part of the swing formation. 1, 2, 3. Look at that buy. So, yes. Yes, sir. All right. It's now currently 10:35 p.m. here in New York, where I live. If there is any other questions, please type them now or forever hold your peace and text me in the DMs and I'll get you your answers, your questions later. Great start to my Saturday morning. Learning all this. Thanks, mate, for everything you taught in the session. Lit work to do this weekend. Facts, friend. Yo, blessings to you, Bubbles, bro. Do your thing. Be safe out there. Enjoy your Saturday, man. No problem, guys. Facts. Yeah, everybody be safe. Yo, do the right thing. This world is crazy. Do the right thing. When nobody's looking, do the right thing, bro. Do the right thing. Especially y'all, bro. Like, I know y'all, most of the demographics is mainly males, bro. Y'all do the right thing, bro. We need more men out here standing on business, bro, and pushing better energy out here, man. Like, gotta do better, bro. Gotta do better. Period. Yo, it's been a blessing, folks, bro. I'm gonna talk to y'all Monday. Monday, bright and early. Be back to it, all right? This is gonna be on YouTube shortly. It's your boy Deontay signing out. Peace. Love, 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 love.